Hello everyone. So here is CMA Final Law Marathon Part 2 that you all have been waiting for. Of course, in 100% English. In the mix of Hindi and English, the marathon is already uploaded. That is, both the parts are already uploaded. Now, coming to certain points which I want to tell you all. This is obviously part 2. Our entire marathon, because it is extremely comprehensive yet in a time bound manner, because now is the time. And if students ask me, ma'am, what is the perfect time to watch marathon, I would say there is absolutely no perfect time to watch marathon. Everyone should watch marathon and revise at their own pace. Okay, so if you believe that, okay, you have completed this 50% syllabus and now you want to have that quick revision which recalls all your entire concepts, and at times you have certain doubts in those concepts, so if they're very important, they'll be dealt in a manner which you'll understand very well. Because I've seen students that they are extremely difficult concepts, or some doubts which have not been cleared over a period of time gets cleared very easily even during marathons. So you can always watch that particular portion, that is 4 chapters, 5 chapters, or whatever it is, right? So watch at your own pace. Don't watch it all at once, except when you're watching it just before exam. You don't have a choice, but you have to watch it in entirety, because you cannot do selective revision, right? You have to revise it in entirety, right? So you can always divide your marathon and revise it like that. Please start now. Please, it's my humble request that start revising now. Otherwise, it may so happen that a one month from now, that is what is left, right? So a month from now, and you will wish, oh, I wish I had started today, right? So we don't want that to happen. So start your revision today itself. And if you're still stuck between concepts, then you need to work on that. And let me tell you, all the juniors or all the students who are preparing for another attempt or so, let me tell you very clearly, you may get some idea of the concept what is dealt in those chapters, but this is not at all the replacement of the regular classes, right? This is revision classes, right? So once you have enjoyed and developed the concepts, now if you revise with me in a manner I am revising, you will enjoy. But otherwise, you need to develop your concepts first, which are built in the main and regular class, for which you can check out our website bookmyvideo.in. Right now, coming to the points which I need to tell you regarding marathon. You all know that how our marathons are, and this is the second part, which covers economic law plus corporate governance. One more input that I want to tell you before you begin with the revision classes, that during the entire marathon, I have used my handwritten charts for revising. Some students find it very comfortable. Some might be okay with the study material that they are using. So great. But if you want these chart book, we have two options available for you. One is the entire set, that is our wonderful set of 7 books, which comes as a hard copy, but that might not suit you because now we have time constraints. So if it suits you, you can always visit our website bookmyvideo.in and go ahead and buy that full set. But if it doesn't suit you because of the time constraint or whatever reason, then there is another option, which is our digital version. So you can subscribe for our digital version of charts, which is available only on Android app, Book My Video, right? So you can check that out. Now, enjoy the marathon, study well, revise well, and of course, there will be a lot more sessions and videos coming up before exams, so stay tuned. Thank you. Okay, now we are supposed to revise SEBI laws and regulations, right? So, in this, we have to basically discuss 3 topics. The very first one is raising finance from capital markets, which is all about studying some portion of SEBI ICDR regulations. Then we have SEBI prohibition of insider trading regulations, which is also known as SEBI PIT regulations. And the third one is takeover code, which is SEBI SAST regulations, or SEBI substantial acquisition of shares and takeover regulations, right? So we'll start with the very first one. Of course, I am revising the entire chapter, but I will try to explain you the little points which actually students skip, and therefore they find the chapter difficult, right? So we begin with raising finance from capital markets, right? First thing, you have to understand that we're talking about making a public offer. Who can make a public offer? If you talk about under Companies Act, it is only a public company which can make a public offer. Right now, when we're talking about SEBI regulations, it's all the body corporates are being covered over here. So even if we go back to Companies Act, we know that under section number 23, public companies can issue securities to public by giving them a public offer, right? Whenever they make a public offer, there are certain provisions of Companies Act that they have to comply with, along with SEBI ICDR regulations, right? Now, if a public company wants to make a public offer, there are two ways, right? You can freshly issue some shares. That means there is a fresh issue of shares or fresh investments. You're writing subscriptions for fresh investments, or you can offer your existing shareholding to public. That is also an option, right? If you're talking about public offer by unlisted public company, that is an IPO, right? Now, when you are making an IPO or when you're making a public offer, again, there are two ways to do that. One is through fixed price method. That is, you have predetermined the price of your security, that I want to offer this particular share for an amount of 1000 rupees, right? So if anyone is willing to pay 1000 and buy that share, they can subscribe for it, right? Otherwise, no. The second method is book building. Book building, when you're not very sure of the competitive prices, when you're not very sure that what is the price the market players or all the investors will be willing to pay for my security, right? You're not sure about the quantity, you're not sure about the price. So the other method and the safer method is book building. So where prices are actually discovered through demand, wherein you actually put a price band, that this is the lower price, this is the higher price, what is the price that you're willing to pay, right? So that is how you apply, and there is a beautiful system which has been made for ascertaining the bids and everything. This is called as bidding, baby, broadly, right? So that is being ascertained, and accordingly it is book building, right? So the issue is being built, fine. You must know this basic before you actually start for the very first question, which is often asked in examination, and that is eligibility of the issuer. But before you know this, you will never be able to understand this well. Now, what is happening over here? Who can actually go for an IPO, right? So who is eligible to make an IPO? Rather, these are the negative points which are written over here, that who is not eligible to make an IPO, right? So if you are an issuer, if you want to issue securities to general public and give them a public offer, then this should not be happening. If this is happening, then you are debarred. Okay, you cannot do that. So the very first condition is that your promoters or the promoter group, or as I told you, the existing shareholders can offer their securities to public. So the selling shareholders or directors, right? So promoters, directors, selling shareholders, if they are applicable, they should not be debarred from accessing capital market by SEBI. So SEBI might have debarred them, just like in a school the students are suspended or rusticated. In the same manner, due to breach of conduct, SEBI can debar a lot of people, right? So if you're debarred from accessing capital market, you are not allowed. Secondly, in principle, approval is something that you have read in Companies Act also, that whenever a company wants to make a public offer, they have to make an application to the stock exchanges for getting approval. If the stock exchange refuses that, no, I'm not going to list your securities, then you cannot move ahead with the public offer. So if you have not made an application to stock exchange for in principle approval, you're not allowed. Next is, you have not made an agreement with depository. See, this is something which is extremely important. You cannot have physical shares. So dematerialization is important, and that's being stored with the depository. Next is, you have partly paid up shares. See, whatever partly paid up shares you have, either you make them fully paid up, or if they are for reasons that the investors have not paid the call money, you asked for them, but they have not paid it. So in such a situation, forfeit the shares. Okay. Next is arrangement of finance towards 75% not made. Now, what is this that you have to understand well? Towards 75% not made. Supposedly, I want to buy a particular property and I want to take a bank loan. The bank will ensure that if the property is of 2 crores and I'm taking a loan of 1 crore for which I'm eligible, the bank will ensure how will you pay the remaining 1 crore, right? So I have to arrange some money, then only bank will give me loan, right? So this is a but obvious condition. Otherwise, what will happen? Bank, I'll take loan from bank, but then I'll not be able to arrange my own money, and that's why all the money that bank has given will not go into the purpose which is it is obtained, and it will go in vain. The same condition has been put here also. If you are up to a project of 5 crores and you're raising funds from public issue of 3 crores, then that 2 crores, 75% of that 2 crores, there should be proper arrangement of finance, so that when you get public money, you're actually able to put in for the purpose that it has been obtained for, right? Then promoters holding is in dematerialized form. It will not be allowed. It has to be in dematerialized form. It is not in dematerialized form. Fine. So it is in dematerialized form, then only it will be allowed. And whatever amount you have raised, you are not supposed to spend more than 25% for general corporate purpose. So if you have raised an amount of say 100 crores, so not more than 25 crores for general corporate purpose like working capital, stock repurchase, etc., etc. Okay. Then the promoter should not be willful defaulter. I hope you all know what a willful defaulter is. If I take a loan, no, let me not take this example. If Mr. X takes a loan and Mr. X is unable to pay the loan because he has run out of money, right? So he'll not be able to pay it back. He's not a willful defaulter. He is a defaulter but not willful, right? But if persons like Vijay Mallya and all, right? So they are willful defaulters. They have ample of money, but out of choice, they have actually defaulted, right? So that is something which is declared by RBI. Okay. Then the issue is going to be open for at least 3 days and maximum 10 days. And if there is non-compliance of minimum subscription, so there should be compliance of minimum subscription. So minimum subscription is what? 90% of the issue. And if that is not obtained, then it has to be refunded within 15 days from closure of issue. Okay, then we come to appointment of intermediaries. What are intermediaries? There are a lot of intermediaries that we read about. We have merchant bankers, then we have lead merchant banker, then we have syndicate member, we have depository, we have the auditors, we have registrar to issue, we have compliance officer. These are all what involved in the entire process, right? So what we have to appoint, that is first you have to understand. Firstly, we need to appoint merchant banker. May appoint one merchant banker or more than one, but if there are more than one, there has to be one lead merchant banker who is going to carry out the entire IPO process. So merchant bankers basically help us in fundraising, in consultancy and everything. Okay. Then secondly, you have registrar to issue. What does registrar to issue do? All the registrars, if I'm talking about registrar of companies, what do? They keep a record of companies. Likewise, this registrar is going to keep a record of the issue, that okay, these are the applications which have been received, these are the refunds which need to be processed, these are the allocations which need to be done, right? Who has received what and all that, right? So maintaining a record basically of that. Fine. The third is compliance officer. Now compliance officer is what? An officer who is responsible for compliance of laws plus redressal of investors. And then we have something more. We have something called a syndicate member. Syndicate member is what? It is nothing but an investment bank, but is needed only in case of book building. I told you there can be two types of issues. So in case of book building, you have a lot of bids which are being invited, right? So that investment bank or that syndicate member actually collect bids. If it is not the case of book building, then the syndicate member is not required. Fine. Other conditions of IPO. Other conditions of IPO means what? Firstly, you have to understand two things. Although I have told you that whenever you are making a public offer, it can either be done by book building or it can be done as a fixed price method, right? But not everyone has this choice. Okay. if you have proven track record of profitability, then only you're free to make this choice. You can either voluntarily go for book building or you can go for fixed price method. But if you do not fulfill these conditions, then you have to mandatorily go for book building in case you want public offer, you want to make public offer. There is no other choice. So what are the conditions that need to be fulfilled? First, tangible assets should be at least 3 crores. At least 3 crores in each of the preceding 3 years. Okay. Now, out of this, not more than 50% should be in the monetary assets. Right, that means your assets should be in the core business. Right, if they are more than 50% in the monetary assets, then you have to make a firm commitment that whatever extra I have put in monetary assets, I am going to plow them back to my business and utilize it over there. Right. So one condition is that. Second is minimum average pre-tax profit has to be 15 crores. Now this is going to be out of preceding 5 years. You will choose your 3 best profitable years and make an average of that, and then check this particular condition that at least it should be 15 crores minimum. Right, if it's more than 15 crores, great. Then net worth of at least 1 crore in each preceding 3 years. Now each preceding 3 years and full, what is it? See, net worth could also fluctuate, right? Maybe you have issued more shares and like things, right? So it has to be consistently more than or equal to 1 crores. It should not happen that at year end I have a net worth of 1 crore, but in somewhere in the mid of the year I had net worth of only 20 lakhs. So this should not be happening, right? If these conditions are satisfied, there's one more actually. If you change your name, then whatever revenue you are making or you have made in the preceding year, you see how much revenue you have made on old name and how much you have made on new name. At least 50% of your revenue should be in the new name. That means now you have got that stability. Okay, so if you satisfy these conditions, great, you can opt for whatever method you want. But if you do not satisfy these conditions, then you have to make an IPO through book building only, and you have to offer at least 75% of your shares what you are offering to QIB, that is qualified institutional buyers, about which we'll actually read when we do that book building process. Okay. So I hope this is clear. Then there are some other conditions also. There won't be any allotment if the allottees are less than 1,000. Okay, there will be no allotment if you have any outstanding convertible securities, that whatever you have to actually issue that. Why are you wanting to issue more security when you already have convertible securities, and that too, that tenure has expired, they're outstanding, right? Then there is going to be quarterly reporting by bank. See, I have raised funds. Now I have to utilize this funds. Till I utilize actually 100% of the proceeds, there will be quarterly reporting by the bank to SEBI. And in your book, you will find till 95% of the proceeds, but actually it's 100. But you can remember for your exam perspective, 95 also. Okay, so I hope this is clear. Right, now we come to pricing. Pricing is what? First thing, you cannot issue less than your face value. That means shares cannot be issued at discount. If your face value is 100, you cannot, your issue price cannot be 99, right? It has to be more than 100 only, right? First thing. Now, how do you decide the price? If it is a fixed price method, you'll decide it in consultation with the lead merchant banker. And if it is book building, so of course it will be decided through book building, but again in consultation with the lead merchant banker, because there you have to mention a price band in that offer document, right? You will either mention a price in the fixed method or a price band. Now, there is some concept called as differential pricing. Differential pricing means you are charging different prices for the same security that you're offering to two different category of people. Right? It is allowed in certain cases. The very first one, the retail individual investors or the employees, right? They may be offered at a price lower than what is being offered to other categories, but the price variation shall not be more than 10%. That means not lower than 10% of the price at which it is offered to other categories. First. Second, if it is book building, whatever you are offering to anchor investor, you cannot offer a price to anchor investor lower than what you are offering to others. What is it? supposedly I know that I'm going for book building, and I don't know how many people will actually like to invest and buy the shares of my company. So there is an anchor investor whom we actually promote, right? This particular person has actually invested in our company. Now that particular person is not ready to invest in our company, so if we offered them a share, that okay, I'll give you the shares for 2 rupees only. However, I'm offering everyone a share of rupees 10, but I'm giving it to you for 2 rupees only. Now this will again be misleading, and people will be like, okay, he has invested, so his money is also at stake, so I can also invest. But this is somehow misleading. So securities, the price that I'm offering to anchor investors is not going to be lower than the price that I'm offering to others. Okay, then if you're not going for book building, then you can offer specified securities to your employees at a price lower than floor price. Fine. Floor price and cap price, the price band that I already explained you. Then you have the face value. What is the face value? If your issue price is 500 or more, the face value has to be, it cannot be less than 1, it can be less than 10, right? If your issue price is less than 500, then the face value has to be at least 10. Promoters contribution, minimum contribution of 20% of the post issue capital, and lock in period of 3 years of minimum contribution, and 1 year for any excess contribution that has been made by the promoter, right? And then we have the book building allocation, which is very important from examination perspective, right? Book building process or allocation, that is what you have to read. Okay, what is it? See, there are two cases. This is the case of voluntary book building, wherein I fulfill the criteria of or I have a proven track record of profitability, and voluntarily I am opting for book building. This is the second case, wherein compulsorily you don't have a choice and compulsorily you have to go for book building. And then there is the other case, the last case, where we are not going for book building. Okay, other than book building, what is going to be the allocation, right? So if you're going voluntarily for book building, you will offer at least not less than 35% to retail investors, not less than 15% to non-institutional investors, that means other than QIB and retail, and not more than maximum 50% to QIB, out of which 5% will go to mutual funds, right? This is something that I've already told you, that at least 75% has to be offered to QIB, and not more than 10% to the retail investors, and not more than 15% to the non-institutional investors. If it is not the case of book building, then you will offer 30% to the retail individual investors, and remaining whatever is there, minimum 30%, right, to retail individual investors, and whatever is remaining, that can be offered to the individual applicants, right? Okay, now we move to insider trading. So before I begin, some sort of concept, and then we can move. So what is it? We are discussing SEBI Prohibition of Insider Trading Regulations 2015. So supposedly there's a company which is about to declare dividend, right? Now, if I get to know that this particular company will declare dividend, I am aware of the market, and I know that, or let me be even more specific. Supposedly, we have a company which has incurred 5,000 crore losses in a particular financial year, but this news has not been made public yet. Once we all consider that particular company to be very good, once this news is out in public, there will be a sharp, steep decline in the share prices of the company. You agree to it, right? So don't you think this financial result is something which is non-public but material and very price sensitive information? It can lead to a lot of price variations. So it is unpublished, that is not available to public. Price sensitive, that means if known to public, it can lead to a lot of price variations up and down and information. So UPSI, unpublished price sensitive information. So financial results of any company is actually UPSI, unpublished price sensitive information. So if before the information is made public, I buy some shares because I have this information, Right, I got this information because my husband is the director of that particular company, right? So he told me that particular information. You know what, my this company that I work in has incurred this much. I said, wow, the share prices are such high. Once this information is out, there will be a sharp decline, right? So maybe I sold my shares or whatever it is, right? So, what happened? Don't you think I will get undue advantage or I made a lot of profit, right? Which others couldn't. So, it is unfair for them. Undoubtedly, yes, ma'am. If I know that the company is about to declare dividend, I bought the shares, a lot of shares, and immediately the share prices went up and I sold the shares. So I made a lot of profit, right? So basically, this particular regulation tries to tell you that you are free to speculate. If you're not connected, you don't have UPSI, you judge this, you do analysis, right? You speculate and you buy, you sell, whatever you want to, you do it. But if you have this unpublished price sensitive information, then somehow you are an insider, and an insider person is not allowed to trade, because this is like giving you undue advantage, right? So that is something which is not allowed. Okay, we have certain definitions. Number one, compliance officer. What is compliance officer? Compliance officer, usually people have a notion that it has to be a CS only, but here it can be any compliance officer. Usually CS is only appointed because they have better knowledge of the laws. It could be any senior officer, and he has to be financially literate, first thing, and he's going to be responsible for all the compliance of laws, compliance of policies, compliance of rules which are also made for preservation of UPSI. So every company has this unpublished price sensitive information, right? When we read about the code of fair disclosure and code of conduct, we'll also get to know that, okay, you identify that price sensitive information, that okay, this financial results, it is a price sensitive information. They basically make a list of the employees, that these are the 4 employees who know about this, right? Just like a police inquiry is being carried out, right? Or when we go, when there is a team who is actually going on a raid, they don't even disclose that where we are going, right? Just to maintain that confidentiality, right? It is just known to 1 or 2 employees, right? So in the same manner, UPSI should also be dealt and preserved. So whose duty it is? Compliance officer. He has to ensure that all the rules which have been made for preservation of UPSI are being followed, right? He has to monitor the trades, he has to implement the codes. Okay, then we have something called as connected person. See, we use the term connected person, we use the term designated person, we use the term insider, right? So what is connected person? Connected person is basically who's connected to the company. Who will be connected to the company? The employees, the directors, anyone who is working with the company in any capacity, right? Or who is associated with the company in any capacity. But if there is a security guard, he'll not be connected person, because connected person is someone who is associated with the company. Maybe you are just dealing with the company every day, going with the going to the company, and you are a technician at the company, and you have access to all the information of the company. You don't work for the company, you may be a freelancer, but still you are a connected person. So if you're associated with the company currently or during the past 6 months, because that information could also be vital. So if you're associated with the company right now or during past 6 months, and you're associated in such a manner that it allows you access to UPSI, then you are a connected person. Now, there are some connected persons who are actually connected. There are some persons who are connected to the connected persons. They are deemed connected person, right? Like, if my husband works as a director in a company, then I am a deemed connected person of that particular company. Why? Because I am an immediate relative. Who is an immediate relative? Spouse, parent, sibling, child. Right? Now, I am an immediate relative of the connected person. So, immediate relatives, holding subsidiary, associate, intermediary, right? Intermediaries that we all know, right? Intermediaries employs any investment company, asset management company, or their employee, director, right? Official of stock exchange, then our bankers, right? Member of board of directors or employee of public financial institutions, stock exchange official, all of these, they're all deemed connected person. Now, if you are a connected person, you are an insider. If you're not a connected person, but you still have UPSI, you are an insider. Okay. What is UPSI? Unpublished price sensitive information which relates to the company and is not available to general public, but which, if become available, is likely to affect the prices of the securities. And it basically includes 5 things, one of which I have already explained you, right? Financial results, dividend, change in capital, mergers, and KMP changes. KMP changes, that is key managerial personnel change. There will be a drastic shift in KMP also. If let's say supposedly we have a huge company and that particular company is being the face of the company is being replaced, that now you are no more working in this particular company and somebody else comes and takes over the management, the people will might have more confidence and trust or might lose trust, and therefore the share prices can also fluctuate and vary, right? So this is UPSI. Now, what is there in this particular regulation? The first thing, there are certain restrictions. Restrictions are on whom? Restrictions are not on general public. Restrictions are on insiders. That means somebody who is a connected person or somebody who has access to UPSI, right? Okay. So what are the restrictions which are being imposed? That you're not supposed to communicate this UPSI to anyone else, right? Firstly, you're not supposed to trade if you have this UPSI, right? In fact, if insiders want to trade, they have to formulate a trading plan. There will be a trading window which is going to be open, right? During that trading window also you have to formulate that trading plan. There is a compliance officer, you make an application to compliance officer, they give you approval, and thereafter you can trade. Okay, so that is how you have to do. And before that also you have to give a declaration that I am not in possession of any UPSI. I don't have any unpublished price sensitive information. I want to trade. I want to buy the securities. I want to sell the securities, right? So they have to formulate a trading plan and do that. So that is how they can do, right? Otherwise, what is there in general, they cannot communicate this UPSI to anyone else. Now, supposedly there is some inquiry going on and law or any act requires that please provide me this information, then in that case you will provide. Otherwise, you're not supposed to communicate it to anyone else. Fine. That means you have to maintain proper confidentiality. Then organization is going to have a digital database of what? Database of all the UPSI. Okay, so this is the UPSI which we have identified. These are the persons who have access to UPSI and everything. So there will be a proper structured digital database which will contain all the information relating to UPSI. Okay. Now this particular database has to be preserved for at least 8 years. Okay. Now, supposedly, I am a connected person. That means I am a director of a company, and I say that I don't know that this company is about to declare dividend, right? So this is UPSI, and I am claiming that I don't know about UPSI. I am a connected person. Will everyone believe me? No. So the onus to prove, it will be deemed that I have access to UPSI. If I want to prove that, okay, I was not in possession of such person, then the responsibility is on me. Otherwise, I will be presumed to have this particular information, right? Okay. Then we have trading plan, I've already told you, right? And then we have certain disclosures. If I talk about disclosures, basically what you can remember over here is that one is initial disclosure. Every KMP director, promoter, they have to disclose their shareholding as on the date of appointment within 7 days of appointment to the company. Second is whenever the promoter or the designated person or the director, who is the designated person? The employees and everyone, right? So promoter, designated person or director, employees of subsidiary also, employees of intermediary also, they are all a part of designated person. If they are buying any securities and the value of which in a quarter is more than 10 lakhs, then within 2 trading days you have to report it to the company, and thereafter company has to disclose it to the stock exchange, right? So these are basically the 3 disclosures that you need to remember. Now we have something called as code of fair disclosure. Code of fair disclosure, what is that? What is code? Code is basically the set of principles which you must follow, right? Like we have a code for independent directors in Companies Act. So this is the code which all the independent directors must follow, right? So here we have code of fair disclosure. Okay. What is code of fair disclosure? There are certain principles which are written in Schedule A. We have code of fair disclosure, and then we have Schedule B where we talk about code of conduct. So they tell us, just like we have model articles and all, like, so here also we have in Schedule A, we have certain principles regarding code of fair disclosure. Every company formulates their own code of conduct, their own code of fair disclosure, but these are the minimum code of conduct which must be there in your own policy. Okay, and likewise we have code of fair disclosure. It is mandatory for listed company, so the board of directors of that listed company are actually going to prepare this, are actually going to formulate this, right? What are they going to formulate? Certain code that how you have to fairly disclose UPSI, right? If I am an employee and I know this and I tell that, my company says go and disclose it, so you go and you tell it to a few people, right? They are misleading the information, communicating here and there. So this is not fairly disclosure of UPSI. So how should it be done? How should it be done? So we have Schedule A, which actually provides us the principles of fair disclosure for the purposes of formulating a code. Okay. What is it? Firstly, there should be prompt disclosure of UPSI. If you relate it and compare it to the Bollywood celeb news, or like supposedly somebody is getting married and there is a complete rumor, right? To settle down this rumor, it is advisable for the celebrities to respond, right? Or maybe it can happen that if you are getting married, you have the marriage the very next day, but you're not disclosing who you are getting married to, there will be a lot of speculations and maybe some good, some bad, right? A lot of information will float. But if you give the same information sooner, then there will only be credible information which is floating, and the investors will not be harmed in such a manner, right? So they'll be able to make an informed decision that, okay, this is what it is, right? So there has to be a prompt disclosure of UPSI sooner, right? Okay, fine. Then secondly, right? Secondly, there has to be uniform UPSI. So whatever you are sending, you have to send that information uniformly to every channel that you are. Channel does not mean the news channel, to every mode that you are communicating to, right? Thirdly, there are a lot of news reports, social media floating, market rumor, etc., etc. You should respond to that, and there should be prompt replies. It should not happen that such because what happens, we are highly influenced by the miscommunication or misinformation which is being floated, especially on social media. So someday we get to know this, we'll be like, oh my god, the share prices of this company might rise, this is the information, and we're buying. So this should be cut down, right? Just to make it more authentic. So there should be prompt replies to the news report and the market rumors, whatever the case be, right? Next is designation of a chief investor relations officer. Now he's going to be a senior officer, and he is going to deal with this dissemination of information. How do we communicate this, right? Then the information that you share with analyst could be lot of complications. So first, whatever information you are sharing with analysts should not be UPSI. Second, you should develop such a practice that you're recording your meeting with the analyst. Okay. So this is how the code of fair disclosure should be formulated. Next, we have code of conduct, right? What is code of conduct? Again, the CEO or the managing director, they can formulate the code of conduct, and this is how every designated person should behave. Fine. So it is for them. It is for them. What is it? What is it? Firstly, whoever is the compliance officer, he is going to report to the board and more importantly to the audit committee. So in the most of the cases, in all the cases, we have audit committee and he has to do that reporting to the audit committee only. First, designated person, if you're dealing in the securities, you're governed by this internal code, right? Then we have time of reopening of trading window is going to be determined by compliance officer. I already told you there is going to be a trading plan which is going to be formulated and compliance officer will approve it. So there is a trading window. When it will be open, that has to be determined by the compliance officer only. Secondly, even if the trading window is open, you have to get that pre-clearance from the compliance officer. Reasonable time frame, not more than 7 days, because after 7 days there could be a lot of information which is floating or there could be a lot of fluctuations, right? You may be exposed to some UPSI, so it's 7 days max, right? And then there is going to be a format for application of pre-clearance, right? And reporting of trades, that these are the trades that I have done during this particular period. So you have to report your trades also and you have to obtain the permission or approval for doing that trade also. Okay. So there is going to be a proper format for that. And so the code of conduct will actually specify that this is the format, this is how you have to behave, this is how you have to seek permission. Okay. And then there is obtaining declaration of non-possession of UPSI before approving trades. This is something that I've already told you, right? That compliance officer will ensure that you give your declaration that you don't have any UPSI. You're not in possession of any UPSI. Fine. Then we have something called as institutional mechanism for prevention of trade. Right, for prevention of insider trading. So I basically told you how it is being made. There is a list of employees and all that, right? So CEO, first thing that you have to do is have adequate internal control. Secondly is for the audit committee. Audit committee, you have to review compliance with the regulations at least once in a year. Although we have a compliance officer, but he's reporting to you, so you must review that compliance at least once in an year. Thirdly, when we talk about listed company, of course, if there is a leak of UPSI, how will you get to know? If there is a suspected leak, you must prevent it, right? So what you should do is, one, you should have a whistleblower policy which all the employees should be aware of, so that they can come forward and they can tell us about, give us information where we can reach to leaks or suspected leaks. Secondly, you should have a policy for inquiring this suspected leak, right? And all the employees, intermediaries, they all have to cooperate. Fine? Okay. Now, SEBI SAST regulations or takeover code, whatever you may call it, right? Again, you need to have some basic idea about the same before we actually begin. So supposedly, there are certain promoters and everyone is happy with the promoters or with the management. They have good, they have 54% stake in the company, right? Now they want to sell certain shares. And when they sell these shares, there will be a shift in the management, a shift in the control, rather, I should say. And there could be certain set of public who don't want to continue with them because they are like that we believed in the vision of these promoters. Now if they're selling off their shareholdings, we fear that this particular company is not going to go very far. So if there is substantial change in shareholding pattern of any company and it could lead to change in control or management, then there is an exit opportunity which is given to the public. Okay, if you want to dilute your shareholding, you want to sell your shares because you believed in that management and now there is going to be a shift, so you can do that, right? So this exit opportunity basically is mandatory, and this is all about takeover code, right? So when we talk about takeover, what is it? Acquirer is taking control of the target company. There are two parties involved. One is the target company, one is the acquirer, right? Who is the acquirer? Acquirer who is acquiring or agrees to acquire shares, voting rights, or control of the target company. So if I have just 10% shares in a company and I am agreeing to acquire, or maybe let me not confuse you with the numbers, because otherwise you will be somehow confused with the open offer trigger events. But let's keep it very simple, that there is a substantial amount of shares which I am trying to acquire, right? So I am an acquirer and the company whose shares I'm acquiring is the target company, right? Now I can make this acquisition on my own or with some person acting in concert. So that particular person is acting with me, right? Acting in concert with me. Who will act with me, right? Who will be with me? Who will act with me? There are certain deemed persons in concert, right? Deemed persons acting in concert, like holding subsidiary or all the companies under the same management company and its directors, the promoter group, the entire promoter group, your immediate relatives, mutual fund its sponsors, CIS its company, VCF its sponsors, right? Merchant banker its client. So they are collectively what? Deemed PAC. Okay, deemed PAC. Then we have something called as frequently traded shares, right? Although these small definitions are asked only in MCQs, they are not asked in a full-fledged questions. But still, what are frequently traded questions? Supposedly a company has 1 lakh shares, right? Then if 10,000, that is 10% of this, if at least 10,000 shares are traded, then it is going to be traded in a span of 12 months, then that is going to be called as frequently traded shares. Otherwise it is not frequently traded shares. Tendering periods means 10 working days to take within the offer period, right? So there is a span of this 10 days during which you can take the offer which is being given to you, right? Identified days, it is 10 working days after the close of offer the acquiree shall make the payment. So they have to actually complete all the formalities and complete all the requirements, right? So that is the identified date. There are basically 5 types of takeover, and this is also a question which is asked in examination. The first one is friendly takeover. Friendly takeover, where actually the promoters are fine, they're willing to sell their shares. Okay, so if I am an acquirer and I want more shares, they are okay, fine, you give us an attractive price, I'm ready to sell my shares. The second is hostile takeover. Hostile takeover is I'm trying to get some shares from this 1% more, 1% more, and they are trying to stop because they don't want the management to shift. So they're not willing to sell, right? They are stopping that, okay, this is the share I should buy, otherwise in the open market they'll buy the share, right? So hostile takeover, when they're actually fighting, they don't want to give away the control and they're defending. The third is horizontal takeover in the same industry. So you're buying a rival, you're acquiring a company or shares of your rival. Vertical takeover may be upward, forward, or maybe backward, like you are acquiring shares of your manufacturer or maybe of retailer if you are a wholesaler. And conglomerate takeover is something very different, right? It is like you are entering into a completely different industry. Okay, so you are acquiring the shares of a company which operates in a different industry. If you're a textile industry, maybe that particular is a drug manufacturing company, right? So it is absolutely different. Okay, now we have certain disclosures, but before actually we go on to the disclosures and exemptions also, I'll tell you later, right? I want to actually first of all deal with the process and everything. I want to explain you this open offer. So there are basically 2 types of offer. One is mandatory and one is voluntary. You have to understand something very, very slowly and gradually. Okay, so let's say Mr. X has 5% shares. Okay, Mr. X has 5% shares. he acquires 10% more shares. So now his total holding is 15%. Okay, no problem at all. Now he acquires 10% more. Now his total holding touches 25%. So as soon as it reaches 25% or it exceeds 25%, maybe the last acquisition was 12%, so it would have become 27%. So it exceeds 25% or it reaches 25%. Then it is mandatory for X to give a public offer. The initial trigger has hit, right? It is a trigger event. As soon as an acquirer, along with person acting in concert, supposedly there's a company who's acquiring shares, there's a subsidiary also who's acquiring shares. So together they have acquired the shares of another target company, shares of worth 25%. Right? So as soon as you reach that 25%, it is mandatory for you to give a public offer to acquire 26% more shares. You have to give a public offer. There will be a detailed public offer. Okay, this is what I'm offering, everything. It will be submitted to SEBI also. Then you'll make an offer, everything. There's an open offer process that we'll read about, right? But you have to give this public offer. They may accept, they may not accept. But it is mandatory for you to give that public offer because it is a trigger event. And why? I've already told you that, right? Okay. So this is one thing. Give public offer according to regulations for at least 26% of the total share capital, right? Okay. The next one is, yes. The next trigger event comes, the second trigger event, which we call, the first one was initial trigger. The second one is second trigger. Now, if you are, actually you have two things. Let me first tell you that. Now, if you are supposedly holding 27% of the shares and you want to acquire 1 more percent, no problem. That will be creeping acquisition. So if you want to acquire 1%, 0.5%, 1%, 2%, like you're acquiring less than 5%, it is creeping acquisition. But if you want to acquire more than 5% in a financial year, then that will be second trigger event. And again, you have to give a public offer to acquire 26% shares or more. Okay, at least 26% shares, of the target company. Fine. So these are the two mandatory offers. Of course, you have to understand one thing, that in any case, when you acquire those shares, your post holding cannot exceed maximum permissible non-public shareholding, because there's a shareholding pattern that at least 30% shares, 35% shares maybe should be with the public. So your ultimate holding cannot be 80%. That cannot happen, right? So minimum, at least whatever is the criteria which has been specified, right? So your holding cannot exceed that. Okay. Now, you don't hit these trigger events. This trigger event you will definitely hit, because the first condition is you should have prior holding of 25% or more. So you must have made this first trigger, right? So you must have made this public offer. Now this particular event has not happened, right? So you're not acquiring more than 5%. If you're acquiring more than 5%, then the second trigger event will hit and you will have to make a mandatory public offer. But this is not happening, right? So what is happening is, if you have a prior holding of 25% or more, you have not made any creeping acquisition in the last 52 weeks, right? You don't intend to make further acquisition in the next 6 months, then you are allowed to voluntarily make a public offer, right? And you can make a conditional offer. What is conditional offer? Wherein you can prescribe the minimum level of acceptance. What is minimum level of acceptance? That if I am offering to purchase 3% shares, if I'm making an open offer to general public to purchase 3% of shares, then if I get at least 2.5% shares, then only I will make payment, and otherwise I'll not buy the shares. So this is prescribing minimum level of acceptance, that my minimum level of acceptance in the given case is 2.5%, right? Once an offer is made, can it be withdrawn? The answer is yes, it can be withdrawn if the statutory approvals have been where is it? Yes, here it is. the statutory approvals have been refused, right, or the acquirer has died, right, or there is any condition made in the agreement which has hit, right, or there is any condition according to which according to SEBI, that okay, it's fine that they are withdrawing, right? So SEBI decides according to the case, right? So if you are withdrawing the offer within 2 days, you have to make an announcement in newspaper, and you have to inform it to SEBI, stock exchange, and the target company, right? Then we have something called as the open offer process. Here comes your open offer process. You have to understand that basically there are just 4 steps involved. What are the 4 steps? First is submission of letter of offer, draft letter of offer, okay, to SEBI. Once you get the response of SEBI, you make the correction and everything, then you give the final letter of offer to public, right? Then your offer opens, and people can apply for that, and thereafter you complete all the requirements and the formalities, right? So these are basically the 4 steps. Now there are timeline and deadline, how it happens. So the event has triggered. When the event triggers, you have to appoint a merchant banker, because the whole process is going to be facilitated by the merchant banker. Then you make a public announcement. When you make a public announcement, then within 5 days you make detailed public announcement. But before detailed public announcement, you have to deposit the amount in an escrow account. So you have to open that account 2 days, at least 2 days before. Escrow account is what? It is just a temporary account which is being opened for a purpose, and when that purpose is accomplished, it is closed, right? So you have to open that and deposit that amount. After detailed public announcement, within 5 days, you have to draft a letter to SEBI, right? And this draft letter of offer is also going to be sent to the target company and the stock exchanges. This is the draft letter. Within 15 days, SEBI will reply and give you the response. Once you receive that response, within 12 days, you have to start tendering period, right? Which is going to be open for 10 days, right? And once you receive the response by SEBI, within 7 days, you will give the letter of offer to public, right? So I hope this is clear. How they can make payment, what is going to be the mode of payment, that can be separately asked. You can make the payment by cash. You're acquiring their shares, you have to make them payment, right? So by cash, right? Or you can give them shares of your own company. Whatever is the offer, it will be written in the offer document, right? So you can give them shares of your company or PAC, right? Issue them debt instruments, right? Or issue them convertible debt securities, right? So whatever it is, or you can other option. Right, withdrawal of offer is something that I've already told you. Now there are 2 more things which you must know. Obligations of target company. What is target company? Whose shares are being bought. Now, what is the target company supposed to do? Target company was supposed to continue your business in the manner you are doing, right? So business has to be conducted in the ordinary course of business. During that offer period, it's not that you'll sit back and relax that, okay, the management is going to change or the control is going to change. No, you have to continue your business in the ordinary course of business. Second, you will not fix any record date during that period, right? The period is specified. Record date means what? Like these on this particular date, whoever is the shareholder will get bonus shares. No, you cannot fix this any record date during this particular period. And secondly, you have to provide the acquirer within 2 working days from the identified date a list of shareholders along with their address, their name, their folio number, right? And if some transfers are pending, that details also. Fine. Then we have obligations of acquirer. Obligations of acquirer means what? Acquirer, firstly, you have to make the payment. So you should have firm financial arrangements. Secondly, you have given them the offer. You must also implement this open offer. Thirdly, this should not happen that you have got control. So you are disposing of some material assets of the target company. Okay, see, I told you that take this open offer. Now you haven't taken. Now I'm going to dispose of the assets of the target company. And now the shareholders will regret that we didn't know that this shift is going to happen. So unless you should declare this intention pre-hand in the letter of offer that after I acquire these shares, after I get control, I'm going to do this. then you can do, otherwise you should not do, right? During the offer period, you or your PAC should not sell their shares, right? And you will be jointly and severally liable for all the obligations. Okay, now the thing that I left is this: exemptions. So there are, these persons or these cases are exempted from the applicability. But obvious, if an underwriter is buying shares or securities, he does not have to apply and follow this entire procedure of takeover, that okay, I have to give an open offer, oh, this is creeping acquisition, I have to do this, I have to do this reporting, I have to disclose this. No, my dear, no. Right? No, this is not going to happen. Why this is not going to happen? Because they are exempted. They do not come under the purview of this regulation. Anyone who is acquiring shares in the usual course of their business, like stockbroker, merchant banker, underwriter, they're not supposed to follow this. Secondly, anyone who is acquiring shares under safety net. What is safety net? Like supposedly I've acquired shares and there is a safety net. That means I have been got a guarantee that okay, if the share prices drop, you can sell your shares. Right now, the person who is acquiring shares under the safety net, it's not applicable. Third, the merchant banker who is acting as a stabilizing agent. We all know that okay, let's say IPO comes up and now the shares are being traded at lower than the offer price, right? So to stabilize that, merchant banker at many times acts as the stabilizing agent by buying those shares. So again, the applicability of takeover code here does not come, right? Then we have acquiring shares pursuant to agreement of disinvestment. Okay, disinvestment or merger, whatever it is. Like in merger also it happens, you are issuing shares to somebody, right? And in disinvestment also it happens, like there is a foreign entity and there are Indian partners who are associated. Now the foreign entity wants to disinvest, so all the shares will be bought by the Indian partners. So in this case also it does not apply. Then we have disclosure. If I haven't told you, person plus person acting in concern, they have to disclose their shareholding if more than or equal to 25%, and they have to disclose their aggregate shareholding and details of encumbrance to stock exchange and target company. Right? Disclosure basically you can read. Fine? Okay, thank you. Let's now revise Competition Act 2002. What is competition? Competition is basically a rivalry, right? Everyone wants to win. So when we're talking about the rivalry between business enterprises, be it suppliers, be it manufacturers, whatever it is, that is competition, right? So basically here when we're talking about Competition Act, we're talking about the rivalry which is going on between the business houses or business enterprises for customers, right? Now supposedly if I am a business enterprise and I'm providing a particular good or a particular service for which no other person is available, I'll have complete monopoly, and whatever price I charge, these customers have to pay that price because they don't have a choice. Contrary to this, if we have existing competition in market, right? So that means now people are fighting for customers, right? There is a rivalry between the business enterprises, a fair rivalry, right? Not by unfair means they're trying to do something, right? It's a fair competition, a fair rivalry. Then everyone will have the desire to innovate, right? I must do something better to attract the customers. I must cut down my cost. I must think to be more efficient, right? So in a way, the whole economy, particularly the consumers, benefit a lot because they have a wide variety of choices to make from, and they have the products available at a lower cost, plus the products continuously innovate. Now this is one aspect to look at. There is one more aspect which is involved over here, is the benefit which business houses get. Prima facie we don't see it was my monopoly, I would have done, right? But they also get the opportunity to innovate, they also become more efficient, and moreover, if you just think in money terms or in just profitability, well, competitiveness. If I am a wholesaler and I am buying a particular good from the manufacturer. Now, the manufacturers are competing with themselves. So the manufacturers look at innovative ways, they cut down the cost. So I will also eventually get the product at lower cost, right? So my cost is also reduced, and thereby I can also make profit, right? So we also benefit, or the business enterprises also benefit from lower prices. Okay. Now, when we listen to all this, what do we come to a conclusion at? Is competition good or bad? Definitely, competition is good and must be promoted, but there should be healthy competition, right? So, to promote sustained competition, there is competition law which is prevalent in our nation, and it is available in a lot of nations. Before Competition Act 2002, there was MRTP Act, Monopolies and Restrictive Trade Practices Act 1969. And this particular act was not in accordance with the modern practices that are happening, and its main focus was to curb monopolies, right? So that was its focus, right? It was restricting a lot of things. Now here in this new modern competition law that we have today, it actually promotes competition. It tells that competition is good. In fact, competition advocacy is there, which is spreading awareness about benefits of competition. Okay, so that MRTP Act is completely repealed. We have Competition Act, which is in prevalent. In MRTP Act, we had MRTP Commission. Now we have CCI, that is Competition Commission of India, and we have Competition Appellate Tribunal, which is nothing but NCLAT. Okay, and this Competition Act came into picture with certain objectives. First, to prevent anti-competitive practices. So whatever practice you're entering into which is considered to be anti-competitive, we will read about the anti-competitive agreements in section number 3. Second is promote and sustain competition. Okay, so competition has to be promoted, that there should be more healthy competition, and whatever competition exists in the market, that has to be sustained also. Third is protection of interest of consumers. Although the primary act for protection of consumers interest is Consumer Protection Act, right? But here when we talk about the consumers, we recognize both set of consumers. What both set of consumers? One, if I am I am a wholesaler, so I am buying goods from the manufacturer for resale, I am also a consumer. And if I am ultimately buying the goods for my own consumption, for self consumption, then also I am a consumer. So whether you buy it for business purpose, commercial use, or you buy it for personal use, in both cases you are a consumer. Okay, then ensure freedom of trade, right? So everybody is going to have the freedom to trade. And last one is competition advocacy. Although you don't have to read about competition advocacy in detail, but you must know the meaning, right? Okay, now, when we come to the definitions part, the definitions, I'm not going to revise them all, but there are certain definitions which are important and you must know it. First one is agreement. What is agreement? See, agreement is not something which has to be formal, which has to be in writing. No. You come to me, you say something, I say, this nod is also an agreement. So, agreement is like whatever understanding we both are coming to, right? It may be written, it may be formal, it may be informal, it may be oral, it may be just express, it may be implied, right? And it may or may not be enforceable by legal proceedings. Supposedly you did this and later on I denied. Now you didn't have any intention to bind me legally, right? So we did not have the intention to create legal binding on each other, yet we entered into an agreement, and it is will be called as an agreement under Competition Act, right? Because when a lot of people agree to a certain thing, this could be beneficial, this could be harmful also, right? When we read about anti-competitive agreements, we read about cartel. What is cartel? Cartel is basically when some producers or sellers or distributors or service providers, whatever they be, they are entering into an agreement. That means they're agreeing on certain thing. What they're agreeing on? They're agreeing to limit the production or distribution or sale or purchase, to control or to attempt to control. Okay, Limiting means they're just saying that, okay, we are not going to distribute more than this particular amount of this goods. Now what will happen eventually? The demand will be generated, right? And because of increasing demand, the prices will rise because there is limited supply of the same product. Why there is limited supply? Not because there is some scarcity, because these group of producers have agreed, or they have entered into an agreement that we're going to limit this production. Why you're doing that? Just to increase the demand, or just to raise the prices, or whatever. So this is not in the best interest of the consumers. This is not in the best interest of competition, right? So this forming of cartel, it's anti-competitive, right? Okay, consumer, I've already told you. Then comes your enterprise. Enterprise, what is the definition of enterprise? It is often asked in examination. Enterprise is basically any person. Person means what? Individual, HF, company, AOP, firm, association of persons, such as I have already told you that, body corporate, cooperative society, any local authorities there, any artificial judicial person, right? So all these are included in the definition of person, which you already know. After that, Department of Government is also included in the definition of enterprise. So person or Department of Government, if they are engaged in any process of the production or supply chain, that means involved in production, storage, supply, or acquiring goods or controlling goods, right, or services, whatever the case be, first thing. Secondly, if they are involved in the business of acquiring securities, holding securities, underwriting securities, right? Securities means shared debentures, other securities, whatever it be. You can do this directly also. You can do this through your some division or some subsidiary also. It doesn't matter, right? So whilst you're involved in any process of the production or supply chain, second, you're doing the business of acquiring, holding, underwriting, or dealing with securities. But what is not included is the sovereign functions of the government, right? So the third thing is that atomic energy, defense, space, currency, all these are not included because we don't want competition to come over there, right? So we will definitely have policies to curtail competition, to curb down the competition. You're not invited over here because this is something which is related to the sovereign functions of government, right? So that is what enterprise means, okay? Now, in this particular chapter, prima facie, we have three things that you have to study because you don't have competition advocacy in your curriculum right now. So three broad things are anti-competitive agreements, abuse of dominant position, and combination. Now, when I talk about combinations are regulated while the other two are completely prohibited. So you cannot enter into an anti-competitive agreement if, how do we know whether an agreement is anti-competitive or not? Well, CCI is the authority which decides that an agreement is anti-competitive or not. How do they decide? We have certain factors. Based on that factor, CCI decides whether an agreement is going to be anti-competitive or not. Okay, fine. So, section number 3, anti-competitive agreements. What are agreements? You already know. There are two types of agreements, horizontal and vertical. Horizontal means the agreements which you are entering with your competitors. Why will we enter into an agreement with our competitors? Supposedly, you are charging 10 rupees for a particular product. Somebody else charges it for 9. Somebody else will come and charge it for 8. Somebody else will give it for 7 only. Now, you were confused and you're not making any sales. So, what you four sellers come together. You four sellers who were competitors, who were involved in the same distribution chain, right? You were not manufacturer or you were in the same chain, right? So you have entered into an agreement that, okay, let's fix the price. Let's not sell this below 10 rupees. So everyone will sell it at 10. Now, if a customer is coming and they're asking you the price, it's 10. They go to some other seller, it's 10. They go to the third seller, it's 10. They don't have a choice. Is it good for the competition? Is it good for the economy? No, it's not. So fixation of prices, an agreement between the competitors, or you can say a horizontal agreement of fixation of price. Here, it's anti-competitive. I'll exactly tell you. Even in revision class, I'll give you such beautiful clarity that you will be sorted. Okay. Now, So agreements are of two types, vertical and horizontal. Horizontal mean between the same stage of production chain, generally between rivals. Vertical means between enterprises at different stages of production chain, like manufacturer and distributors, right? Now, listen. Any agreement which creates or is likely to have an appreciable adverse effect on competition is void. How do we know that an agreement is having an appreciable adverse effect on competition? That is determined by CCI by looking at certain factors. However, there are 4 horizontal agreements which are identified in the Act as anti-competitive. So they're presumed to be anti-competitive. What? The first one I already told you, the horizontal agreements which actually are entered and they determine sale or purchase price, fixation of price or determining sale or purchase price in any manner. Secondly, if they limit or control production, supply, technical development, investment, whatever it is, right? So that is also anti-competitive. We are entering into an agreement, we are saying we are all producers, we are entering into an agreement, will not produce this much or will limit our production. This is cartel also. Okay, so it may be by forming a cartel or by not forming a cartel, it doesn't matter. It's a horizontal agreement which are presumed to be anti-competitive. The third one, if you are horizontal, you are entering into a horizontal agreement and you're dividing the area. Okay, in this area you sell, in this area I will sell. What is this? That means I'm not going to come and hinder over there. You don't come and hinder over here. So you charge whatever amount you want to. I'm going to charge whatever amount I want to. So no competition at all. It's anti-competitive. And the fourth one is bid rigging. What is bid rigging? Disturbing the entire process of bids. What is bids? Like I explained you, government tenders also. So what is happening? We were supposed to quote a price. Now we decided not to quote against each other. Right? So any agreement which is actually reducing the competition for bids or eliminating it or adversely affecting the entire process, that is bid rigging. So these are the 4 agreements which are entered, which are horizontal agreements and are considered to be anti-competitive. So they're presumed that, okay, if this particular agreement is entered, we don't need to look at all the factors, we don't need to analyze, we don't need to decide whether it's anti-competitive or not. It is presumed to be anti-competitive, right? Then we have certain vertical agreements. Now, vertical agreements, they'll be decided by the same process, but you have to read and you must know about these vertical agreements, these type of vertical agreements. The first one, tie-in arrangement. Now there is a seller and there is a customer or a consumer, right? So he wants to buy a gas connection and the agency tells that if you want to buy a gas connection, you must take the stove also from us. Now this is what sale of one product or one service is tied with taking the other product. Now, I don't want that. That might not be useful for me, but still I have to take it. Or maybe I'm not liking the quality that you are delivering of the stove. I want some other stove. But because it is a condition which is tied up and I have to take it, I'll not go to the other person. Right? So there, that market, the market of stove is also being affected here. Right? So that is tie-in arrangement. The second one is exclusive supply agreement, right? What is exclusive supply agreement? When you restrict the purchaser that you are not going to deal in any goods other than my goods. That means I am going to supply to you and you are going to be our exclusive supplier. Okay, so you are not going to sell the goods of any other seller. Third is exclusive distribution. Exclusive distribution, that is dividing area. That means I am going to give you and you are supposed to sell only in this particular area. Like we have Zepto, Franchisee, Blinkit and all that, right? So they have an allocated area or radius of maybe 2 kilometers and they have to supply within that area only, 2, 3, depending upon the requirement, right? Now, you might say, ma'am, then this is valid. This is not anti-competitive. Where did I say that vertical agreements are anti-competitive? No, they have to be decided based on a lot of factors. Okay. Next is refusal to deal. When somebody, when there is an agreement which actually, it's a very broad thing. It's a very broad thing, right? Like you come to me and I am providing you cement and I say that, okay, I am not going to deal with you and I am not going to provide you the cement. Now I am the only cement manufacturer, so I have to supply, I must supply it unless there is some scarcity, unless there are conditions, I must do that, right? So refusal to deal is a vertical agreement. When we enter into like, I have collaborated with all the other suppliers, I am the manufacturer and I have collaborated with all the other wholesalers to eliminate you from the market, and I have refused to deal with you. Okay, this is how it works. And then we have resale price maintenance. Resale price maintenance is basically to harmonize the prices. And I may put a condition that, okay, you are not supposed to sell this goods below this particular price. Okay, or we have the concept of MRP also, which actually helps in price maintenance, that nobody is going to sell it above that particular price, right? So it works both ways. Fine. Okay. Now, whatever this restriction we are talking about, it's not going to be applicable if we are trying to protect our rights which have been conferred under copyright, patent, trademarks act, etc. Right? Then we have section number 4, which talks about abuse of dominant position. Now here you have to understand that dominant position is not bad. What is bad is abuse of dominant position. What is dominant position? It is the position of strength, right? Where you believe you can operate independently of the market forces and the competitors. It doesn't matter what is here, what is not here. I have this much sale and I am going to have this much sale. It doesn't matter what my competitor is doing. Not concerned. Okay, I have the sale. However, if you compare and look at the small, okay, let me proceed further, right? Now, what is abuse of dominant position? So if there is an enterprise which enjoys a dominant position in a particular market, now it is imposing unfair or discriminatory condition in the purchase or sale or the price, that is known as abuse. That is known as abuse. Okay, like unfair pricing, predatory pricing, limiting production, barrier to entry, using a position to gain advantage, and a lot more things, right? How do you identify whether there is abuse or not? Firstly, you have to identify whether they're enjoying dominant position or not. So determining dominance has to be on these factors. Just a second, has to be on these factors by CCI, and thereafter we check whether they are doing this or not. If they are doing this, then that is abuse of dominant position, and thereafter orders from CCI will follow. Okay, now wait. When we talk about abuse of dominant position, what you have to remember or what you have to write from examination perspective, that is also important, right? So first thing, when you are enjoying the position of dominance, right, and what you do is you use this dominant position in one relevant market to enter into or protect the other relevant market, that is going to be abuse. Why? Because you are already well established in a particular market, and now what you're trying to do is you are using this position or you're using this advantage to enter into the other market, right? Just a second. Like if I am manufacturing printer, okay, now I am forcing my customers that if you buy printer from me, you also are supposed to take ink from me, right? So this is what I'm doing. I'm using, because I'm a very well established brand, like supposedly I am HP, right? There are thousands, lakhs of printers which are being sold every day, right? So if I want to enter into the market of ink, I should have got that ink separately. I should not have used this dominance to enjoy the other. That means I am doing abuse, okay, because I am enjoying a dominant position in the printer market, right? Relevant market is determined on the basis of relevant geographic market and relevant product market. We have certain factors. We'll talk about the factors later, right? Then what else do we have? We have the conditions which are being imposed on the people which are not relevant, or you are indulging in any such activity, or you're limiting the production, as I told you. Okay, let me tell you one by one. First is unfair pricing. What is unfair pricing? Supposedly I'm enjoying dominance, right? So there is nobody else who can compete with me. Now I can charge whatever price I want to. I know that, okay, in this area I charge this water bottle for 10 rupees, but in this area a lot of elite class lives, so I'm going to charge the same water bottle for a price of 100 rupees. Can I do that? The answer is no, I cannot do that, right? And I should not do that unless I can justify that, okay, when I come to this particular area, the transportation cost is high, so it adds up to my cost, right? So unless I can do all that, this is going to be abuse, right? Second is predatory pricing. Predatory pricing is selling below the cost. Okay, so if I am a very big market player and I sell a particular product for 10 rupees, there are many other market players who are trying to establish their market by selling the same at some 9 rupees, or matching up to the quality, etc., etc., doing all of that. Suddenly, what I did is I started to sell the same product at 5 rupees. My cost is 6 rupees, I'm trying to sell it at 5. Now because I'm such a big market player, I can survive that. And why I'm doing this? To eliminate all the competitors, that they will not be able to match this price, so everyone will come to me only, and hence the other market players will be eliminated. So this is again abusing the dominant position. See, it when you are reading about this, you might be confused whether it's anti-competitive agreement or abuse of dominant position. So mostly are anti-competitive agreements if you're doing it, or if you are entering into an agreement with any other person. If you're doing it on your own, well, it will either not affect the market if you're not enjoying the dominant position, or if you're enjoying the dominant position and it's affecting the market. So of course, if you're entering into an agreement, right? And in practical scenario, if you look at CCI orders, if you look at the cases, there is a mix of the alleged contravention is usually contravention of section 3, section 4, and likewise, right? So practically there are a lot of things. Clear? Okay, so moving to the next part, combination. What do you mean by combination? Now, combination is basically acquisition or merger, right? What is acquisition? There's one enterprise which is trying to acquire the shares or assets or some division, or trying to control the assets, or trying to control the management, right? So this is basically acquisition. There could be merger, two entities are joining and becoming as one, right? We're not concerned about that. What we're concerned of is, whenever such acquisition or such merger is taking place, you are surely going to be bigger than before. And when you become bigger, you get a lot of powers. You may be becoming more dominant, and you may be doing abuse, right? So this is somehow, prevention is better than cure. So we are presuming that this might happen, right? So we are trying to regulate the combinations at an early level so that such harsh effects are not seen. Now, if there are two small entities which are coming together, and after coming together they have an asset of 2 crores, well, it hardly matters. It is not going to affect the competition in the market, right? It's not going to hinder, it's not going to be at loss for the consumers, right? It is going to be fine. So they're not concerned. CCI is not concerned. CCI is concerned for the big mergers, right? Big short mergers, right? So that is combination. If there is a merger or acquisition, and after the merger or the acquisition, the combined assets and net and turnover, the combined assets or turnover, I should say, exceeds a certain threshold, then that is going to be termed as combination. And if you're entering into a prospective combination, you must send a notice to CCI. It's going to be regulated, and you need to get the approval, and thereafter you can proceed with the combination, right? CCI can also hold an inquiry against the combination, ask for information, and thereafter accord the approval. Okay, so this is how it works. Now we have 3 types of mergers, acquisitions, whatever you call, and there are 3 types of limits which are given, but you have to read only about 5A. So this is the limit which is given over here. And of course, this is the limit which you must learn by heart, right? You also must learn 1 CR, 3 CR, the assets and the turnover in India. That also you have to remember. Okay, so this is what you'll learn. Now, if any person is entering into a combination, they have to get board's approval within 30 days. Once they get board approval, within 30 days, they have to submit their proposal to CCI, and CCI is going to grant you approval. If they do not respond within a span of 210 days, which eventually has been reduced to 150 days, but since I'm not dealing with the amendments of Competition Act over here, because they're not yet notified for in your syllabus, so right now we're doing this only. Later on, when it is done, then I'll tell you. Okay. So if no reply is received within the stipulated time, it is deemed acceptance. Otherwise, you'll get the reply, right? When we talk about CCI, the question is, what is CCI? So CCI is a regulatory body, or whatever you may call, established by central government, right? So CCI is operative. CCI has its headquarters at New Delhi. CCI has its wonderful composition. Basically, CCI can or is going to consist of chairperson plus minimum 2 and maximum 6 members. They are going to be whole time, right? They will have or they are going to be the person of knowledge, experience of not less than 15 years. That means at least 15 years of experience in commerce, law, finance, industry, public affairs, right? Competition, whatever it be, right? 5-year tenure, and they are going to retire at the age of 65. There are going to be certain duties of Competition Commission of India. What are their duties? They have to overall ensure freedom of trade, protect the interest of consumers, promote and sustain competition, right? All of that. So whatever is the objective of Competition Act, the same are the duties of commission also. Okay. They are going to meet at such place and time as may be decided, as may be prescribed. They are going to decide all the questions by voting, and majority votes are going to be the decision. If there is equality of votes, the chairperson or the senior most member who's presiding shall have the casting vote. There is going to be quorum of 3 members. Okay, so this is about CCI. Now, because first we are doing about combination, I will first of all deal with combination only, and then we'll come back, right? So combinations are to be regulated, that we very well know. Now, if you have entered into a combination, within 1 year of combination, there can be an inquiry against you, right? What happens, CCI comes to some information or suo motu, it may form a prima facie opinion. If it forms a prima facie opinion that there is no adverse effect on competition, then it is going to pass orders accordingly. It will approve, right? If they find that, okay, prima facie, I feel that this is likely to create an appreciable adverse effect on competition, they are going to send the notice to the parties involved, show cause notice as to why investigation shouldn't be carried out. Okay, and they have to respond within 30 days. Now, they may also refer to the Director General and ask for their report. Okay. Now, once they have got the response, within 7 days, they are going to give another direction to the parties. Direction to publish details of proposed combination in newspaper within 10 working days. Here in the entire section, you find working days only. Okay. Even if it's not written, it's working days. Now, when it is published, within 15 days, you can, or anyone can, file objection. So invitation is being made to file objection within 15 days. Once the objection is filed, within next 15 days, CCI has the power to ask for more information. And when it is asked, then within 15 days, you have to provide for more information. Once it is all done, then within 45 days, CCI is going to pass orders. What order? It may approve, it may reject, or it may suggest modification. Now, modification may be accepted by the parties, or it may not be accepted by the parties. If at all it is accepted by the parties, it will lead to combination approval and you can proceed. If it is not accepted, then you have 2 choices. Accept that okay, it is being rejected. Or you can propose an amendment. If you propose an amendment, again, commission may agree or CCI may not agree. If CCI agrees, great. If CCI doesn't agree, then you'll get again 30 days to accept the original modification which was suggested by CCI. If you accept, approve, not accept, it is considered to be anti-competitive, and it will not be allowed. It will not be allowed. Fine. Okay. Then we have other agreements, anti-competitive agreements or abuse of dominant position. So we have contravention of section 3 and section 4. CCI has the power to inquire into alleged contraventions of section 3 and 4, right, in the same manner, where you don't have to read in detail the manner. So this particular page I'm not dealing in detail, right? And thereafter pass certain orders like what? Discontinue this particular agreement that you have entered into and never to re-enter. Impose penalty. This is the penalty which may be imposed. Penalties I'm not telling you, you have to learn them, right? Modify a particular agreement or pass other orders as may be imposed. And then there is a separate topic called as division of dominant enterprise. So if there is a dominant enterprise and it is likely to create a monopoly or create such adverse effect on competition, then CCI may ask that okay, this particular enterprise must be divided. Now when you're dividing the enterprise, there are a lot of associated other orders which have to be passed. Like if you're dividing the entire unit, which assets are going to belong to whom, so how asset division is going to take place, how the shareholders will be allotted the shares, right, how the contracts will be assessed into, because you're dividing an enterprise, right? So all these orders are going to be along with the order of division, right? So separately, this particular question is often asked in examination, that you have to write about division of dominant enterprise. So you will write about division of dominant enterprise in such a manner, right? Okay. Now, there are certain factors which are to be considered by CCI when you are determining whether an agreement is creating an anti-competitive effect or not. Then you will see, is this agreement creating a barrier for others to enter? Is it driving existing competitors out of the market? Is it creating some benefit to the consumers? If yes, then it might be beneficial and not anti-competitive. Is it resulting in improvement in the production or promotion of development? When you want to identify that whether you are enjoying a dominant position or not, the first thing and the most important thing is market share. If the market size is 1000 and you have a market share of 800, there is definitely dominance, right? Size of resources, then size of competitors. When you have some big competitors, like you might have a good market share, let's say 400, but then there is another competitor who again has a market share of 400, then you might not be enjoying dominance, right? Economic power that you have, vertical integration. Usually what happens is, if you're a manufacturer also and if you're a wholesaler also, right, so you have more dominance in that particular market because you're not dependent on others, what they do, right? Then market size, social obligations, entry barriers, monopoly, others. If you want to determine the geographical market, you have to look at the trade barriers, because geographically there might be some state laws which are prevalent, right? Local requirements which may be there, procurement policies which may be there, distribution facility that you have in some area, you have a very good distribution channel, in other area you might not have a very good distribution channel, so the geographical market will be different, right? The transportation cost, you can sell Maggi over here at 20 rupees and the same Maggi is sold in Ladakh at 200 rupees also, because of the transportation cost. So the geographical market is not the same, right? You can always justify that. The language, the preference, after sales. If you're determining relevant product market, end use, who are the end users, price, preference, right? In-house production, existence of specialized producers, classification of industrial products, right? So these are the factors. And lastly, we have something called as appeal. Okay, what is appeal? Penalties, again, I told you we have a lot of penalties which you have to learn. So penalties, you'll be doing it on your own. We have one section called as Section 31, acts taking place outside India but having effect on competition in India. So what is exactly that? There may be a cartel which is formed outside India amongst all the producers who are outside India, but we are buying from them and they have formed a cartel and it's heavily affecting competition in India. So CCI actually has the power that if there is an agreement which is anti-competitive and it is entered into outside India, or when one party is outside India, or there is any enterprise which is abusing the dominant position outside India, right? It is having effects in India. A combination has taken place outside India. A party to combination is outside India, or any such matter, related matter, but it's having an effect on competition in India, then CCI can pass orders against that also, and CCI can put them on hold, right? Although there are not many regulations, this is not a very regulated sector that, okay, our CCI is controlling all the acts outside India. So this is not something which is regulated sector, and a lot has to be made. A lot of regulations have to be made in this regard. Okay, then penalties you're going to do on your own. We have a section called as contravention by companies, wherein we know that, okay, if the company is contravening competition act, then apart from the company, we also have to make liable the officers, the directors who were involved at the time when contravention was committed, right? So they also are going to be charged as guilty and they will be proceeded accordingly. They cannot be charged as guilty, or they can be saved if they prove that, okay, I did not have any knowledge about this particular alleged contravention. I was enjoying my Europe trip or something like that, right? So if they prove that the contravention was done without their knowledge, then the contravention, then they will not be liable. Apart from that, we have the process of appeal. So CCI passes a lot of orders under Section 31, orders against Section 3 and 4 that we have read, right? If you are not satisfied with the order by CCI, oh, CCI has imposed so much penalty on me, CCI is telling me to divide the enterprise, no, I'm not happy. Well, what you can do is you can appeal to Competition Appellate Tribunal. It is nothing but NCLAT. Okay, now they are going to hear your appeals, they are going to dispose of the appeals, they are also going to adjudicate a lot of claim for compensation which arises within 60 days from the order. If you're not happy with the appeal, with the decision of appellate tribunal also, then you can within 60 days appeal to Supreme Court. Otherwise, in general, the appellate tribunal is going to be bound by the principles of natural justice. They are not going to be bound by the procedure which is laid in Code of Civil Procedure, right? So they can regulate their own procedure. However, they will have the powers of a civil court. Okay, so I think this is clear. Okay, so now the revision of Foreign Exchange Management Act 1996. Now, let's come straight to the point. That is the first relevant topic, residential status. But before we read residential status, before we revise it, we also need to know who a person is. So a person is an individual, HF, company, partnership firm, LLP, any body of individuals, association of persons, all of that. Apart from that, a person, any branch, office or agency is also a person. So they are also separately distinguished as persons and their residential status is also need to be determined. Fine. But why do we need to determine the residential status? Because we have to make rules for entering into foreign exchange transactions. Ma'am, what is foreign exchange transactions? First thing you have to understand is what is foreign exchange. Foreign exchange includes foreign currency. What is foreign currency? Foreign currency means any currency other than Indian currency, that is INR. What is Indian currency? INR, of course, but what is currency? Currency does not necessarily mean the currency notes, but it includes the letters of credit, the checks, travelers' checks, postal orders, money orders, everything, right? So a lot of part is included in currency. Indian currency, anything other than Indian currency is foreign currency, and foreign exchange is beyond foreign currency because it also includes the deposits, etc., which are payable in foreign currency and some other things. So ultimately, foreign exchange is something for which rules are made. Why? Because the government is regulating the same. Okay. So first thing is to determine the residential status. You can be a person resident in India or you can be a person resident outside India. Who a person is, that you already know. Now, this residential status, when we have to determine for an individual, how do we determine that? If I have to check, if I have to enter into any foreign exchange transaction, I want foreign exchange, I want dollars. Will I get it or will I not get it? That depends upon my residential status, that whether I am a PRI or whether I am a PRY, right? So if I reside for more than 182 days in previous year, that is the first condition which must be fulfilled for me to become a PRI. If that condition is not fulfilled, straight away I am a PRY. That means even if I have come for employment from some other country, but then I do not fulfill this first condition, I will be a PRY. If I fulfill this condition, then still some things need to be checked. That is condition number 2 needs to be checked. Why have I come out? Why have I come to India? I have come to India, and in the previous year, I was in India for more than 182 days. Supposedly, I am not residing permanently in India. I have come to India. So why have you come to India? If I have come to India for business, for vocation, for employment, or for an uncertain period, then they'll consider me as PRI because now I'm here to permanently settle down. But if I've just come to India for some visit or anything like that, and I've stayed for some longer tenure, they will not consider me as PRI. So I will be a PROI. I hope you can find and trace it in the chart. Now, if I have gone out of India, so why I have gone out of India? Have I gone out of India? I was there in the previous year for more than 182 days. If I've gone out of India for employment, business, vocation, or uncertain period, then I am a PROI. From the same day when I go out of India, I cease to be the PRI and I become PROI. But if I have just gone out for some visit and all, I will still be a PRI. Now we come to persons other than individual. Persons other than individual. That means a company, LLP, anything like that. So if they are incorporated in India, PRI, not incorporated in India, PROI. But the branch, office or agency, they're not incorporated anywhere. They are located. So if they are located in India, undoubtedly PRI. But if not located in India, that means located outside India, then in all the cases, they are not PROI. Sometimes, if there is a branch, supposedly a company is here, but branch is somewhere else, that branch is controlled by this Indian company. So that branch will also be a PRI. So any branch, office, agency which is controlled by or owned by PRI, then that will also be a PRI. Otherwise, it will be a PROI. Now, after we have known the residential status, the question is, how can you get foreign exchange? So no person can deal in foreign exchange according to section 3 on its own. You need someone who is authorized to do so. We have someone called as authorized person, about which we read in section number 10, though I will tell you. There are 3 basic authorized person: authorized dealer, which is the banks, money changer, and offshore banking unit. So only they are authorized person to deal in foreign exchange. So if we want foreign exchange for any purpose, supposedly my relative stays abroad or I am going out of India, then I will need some money undoubtedly. So I need dollars. Where will I get dollars from? From these authorized person only. I cannot get dollar from anywhere else. I cannot make any payment outside India. I cannot receive any payment from outside India just like that. I cannot acquire any asset outside India. But we all have that, right? There are people who have that, right? So this whole section 3 is written like except as otherwise provided in the act. So if any act, provision of act, if any rule, if any regulation, if any master direction, circular, anything permits, then that can be done. So it's not that these transactions are prohibited, these things are prohibited. No, generally this is the instruction which is given except as otherwise provided under the act. Then come to section number 4, which talks about holding of foreign exchange. So I cannot hold dollars. I cannot acquire, I cannot hold, I cannot own, possess, transfer anything, not foreign exchange, not foreign security, not immovable property. However, there are provisions which permit the same. So according to those provisions, I can hold, I can transfer, I can possess, I can do those things. Clear? Fine. There are two types of transactions, and the two most important things that we have in this chapter: current account transactions and capital account transactions. Both are defined in section number 2. Capital account transaction, any transaction which alters that is assets, foreign assets and liabilities of PRI or Indian assets and liabilities of PROI. What is current account transaction? Anything other than that. But current account transactions definition specifically includes 4 things. If you are making payment for trade, that is import export, it is current account transaction. If there is short-term credit, as we have discussed, buyer's credit, supplier's credit, they all are current account transactions. Interest on loans, income from investment, living expenses for your children, parents, spouse, travel expenses, education expenses, medical expenses for your children, parents, spouse, right, along with your own self. So they are all current account transactions. Now, 2 things we have read so far: residential status and the transactions. That means, ma'am, if I want to travel abroad, it is a current account transaction. Is it permitted? I mean, we have made the classification, but how do we come to know that we can enter into such transaction or not? So current account transactions are all freely permissible unless they are prohibited. They require approval of CG, of RBI. Okay. So we read current account transaction, section 5, read with Foreign Exchange Management Current Account Transaction Rules 2000. All these are freely permissible unless. So we read these with these rules, and rule number 3, 4 and 5 are important, and schedule 1, 2 and 3 of this is important, right? So in schedule 1, we have a list of prohibited current account transactions for which you cannot get foreign exchange. Let's have a look at that list. See, they are all permissible unless they fall in the list of rule 3, schedule 1, prohibited transaction. Roll of foreign exchanges not allowed. If you are traveling to Nepal and Bhutan, obviously their Indian rupees freely convertible, freely acceptable, so you don't need foreign exchange for travel to that places, and you'll not get foreign exchange for the same. And then there is a list which is given in schedule 1. If you have earned a lottery and you want to remit that lottery money out of India, you'll not get foreign exchange for that. If you want to get foreign exchange for purchasing some lottery ticket or some magazine which is banned, no. If you want to pay commission on exports, you will get foreign exchange, but not to joint venture or wholly owned subsidiaries. If you want to pay commission on exports under rupee state credit route, no. Rupee state credit route is a kind of arrangement between 2 governments, okay, wherein government is giving you a platform that you export. So why do you need to pay commission? Dividend balancing. Sometimes dividend is required to be balanced with an equivalent amount of inflows. Only then outflows are allowed. So it has going to be balanced. So ultimately foreign exchange is not required. Callback services. That means you are not using Indian telecom operators. Instead, you are using a telecom operator of some other country. That is person is calling you back and is connecting you to some other country. So this is ideally which has been stopped also, and for this, you will not get foreign exchange. Likewise, NRSR account has also been discontinued, but the interest of it will not give you foreign exchange. Okay, so this is a huge list, I know, but then you have to learn it. In fact, it is being dealt in classes in such a manner that I don't think any student anywhere, it doesn't matter where you are studying, how you're studying, but you take it repeatedly. So ultimately you end up learning it, I am sure. Okay, then we have schedule 2. The transactions given in schedule 2 require central government approval. Now here central government means through respective ministries. So central government works through its respective ministries, and those ministries will give you permission. So withdrawal allowed if approval obtained. First thing, cultural tours, Ministry of HRT. So if you want to go for any cultural tour and you want foreign exchange for that, you have to get approval from Ministry of Human Resource Development. In fact, there is a proper Department of Education and Culture, from where you get permission. Then these coming 3 points are for PSUs specifically. If they want to get advertisement done in print media, which the amount of which exceeds 10,000 USD, they will not get foreign exchange unless they get approval from the Ministry of Finance, Department of Economic Affairs. However, in 3 cases, they get foreign exchange without CG's approval. When they want to advertise their tourism or for international bidding or for investments. Freight of vessel by PSU. So if PSU has to pay freight for hiring a vessel, then foreign exchange will be given only when you obtain the permission from Ministry of Surface Transport. If PSU or government department is making imports on CIF basis, that is cost, insurance, freight, everything they are bearing, then also they need approval. Same, Ministry of Surface Transport. Multimodal transport operators, who are they? The operators who get the goods transferred from one place to another, but they are using different modes of transport, not just one mode. That is not just by truck, but maybe by truck, sea, truck, something like that, right? So in such a situation, the facility that they use abroad, that is their agent, they collect money in INR, but they have to pay their agent in foreign exchange. So for this payment, you need to obtain a registration certificate from the Director General of Shipping. Hiring charges of transponders. If you want some of your show to be telecasted somewhere else, then you have to pay for that, right? So you need to obtain permission from Ministry of Information and Broadcasting. Container detention charges, the huge containers wherein the goods are being filled and they're being exported, or they're being shipped, right? So those containers are being hired and you have to pay charges from them. If you detain it for long, then you have to pay more charges, right? In such a situation, there is a rate which is prescribed by the Director General of Shipping. And if you exceed that rate, that means you need more funds to pay for that, then you need to obtain the permission. And thereafter, you can pay it. Prize money. Sometimes there are a lot of activities which happen abroad. So international, national and state level sports bodies can sponsor any amount. But if we want to sponsor any amount, then 1 lakh USD is the upper caping. After that, we need to obtain the permission from Ministry of HRD, again, Department of Youth Affairs and Sport. Then membership of P&I Club, Protection and Indemnity Club. This is again for a kind of ship insurance. But for that, you need CG's approval. Okay. Insurance Division of Ministry of Finance. Fine. Now, first schedule, prohibited. Second schedule, CG's approval. Third schedule, this is like freely permissible kind of transactions. They have a caping. They have given you a limit. If you do the transaction within this limit, no approval. Beyond this limit, RBI's approval is needed. What is the limit? There's a huge limit which has been given, 250,000 USD per financial year per person, right? So a huge limit has been given. So if within the limit, within prescribed limit, withdrawal without RBI's approval, it exceeds the prescribed limit, then approval is needed. For what transactions, ma'am? Private visits. There are some specified transactions and then there is a buffer. All kind of capital account transactions are covered here. Unless they are prohibited and others. Private visit. If you go on a private visit to any country other than Nepal and Bhutan, because for there you don't need foreign exchange. So if you visit any country, then you can get up to 250,000 USD without any approval. If you want to gift, if you want to donate. If you are going out for employment, if you are immigrating, you're shifting to another country, maintenance of your close relatives abroad, for your business travel, for your medical treatment, for your studies, and all other types of capital account transactions are covered here. There are 3 stars which I have made, 4 stars, some people might say. immigration, medical treatment, and studies. Now, these are three expenses for which 250,000 USD might not suffice, because if medical treatment is very huge and expensive, then every time obtaining RBI's approval will be a little difficult, and even RBI will be occupied with so many applications. So for them, it is written that it is permissible up to your actual expenditure. So even if your actual expenditure is more than 250,000 USD, then also it is allowed, it is permitted. Fine, ma'am. So these for individuals. Now we have some permissible things for other than individuals also. So they also have a limit. If it exceeds that limit, you need RBI approval. If it is within the limit, you don't need RBI's approval. But what is the limit? The limit is separately given for each type of transaction. The first thing, supposedly there is a company who wants to donate for creation of chair, or contribution to any educational institute or to any technical institute which is working in the same field. Up to this amount, what amount? This amount has to be calculated. This amount will be lower of 1% of your exchange earnings of 3 years or 50 lakh USD. So whatever amount comes, up to this amount you can donate without RBI's approval. More than this amount, you need RBI's approval. If you want to pay commission, you have a flat in India, you have sold it to some foreign person who was brought by an agent abroad. So you have to pay commission to that agent, for which you need foreign exchange. The maximum amount that you can get without approval is the amount calculated, which is higher of 25,000 USD or 5% of inward remittance. Next, you are paying for consultancy services. Consultancy services have a huge capping. If it is infrastructure consultancy up to 1 crore USD, you don't need RBI's approval. And for others, 10 lakh USD. If you have to pay for pre-incorporation expenses for that, then higher of 5% of investment which has come, or USD 1 lakh. Right? Okay, fine, ma'am. Of course, all those transactions you have to learn, because a lot of questions are being asked from current account transactions and capital account transactions. So this is the summarized version. Section 5, they're freely permissible unless these three. So there are three things that we have to learn. Coming to capital account transactions. Now, unlike current account transactions, their nature is kind of reverse. They say that current account transaction allowed only if permitted. So they have a list of permitted things. They don't have the list of general things that everything is permitted except this prohibited. Of course, they have a list of prohibited transactions as well. However, they also have a list of permissible transactions. So some permissible transactions. Here, one important difference that you must keep in mind, Section 6 read with Foreign Exchange Management, Capital Account Transaction Regulations 2000. There we had rules prescribed by central government. Here we have regulations specified by RBI. Okay, so in that regulation, we have Schedule 1, we have Schedule 2. Okay, so there is some permissible transactions. For PRI, it is given in Schedule 1. For PROI, it is given in Schedule 2. Then we also have some prohibited transactions, and we have certain types of transactions on which restriction cannot be imposed. Okay. First thing, the transactions on which never CG or RBI, no one is going to impose restriction. That is amortization of loan, that is repayment of loan, depreciation of direct investment. Direct investment means investment in equity. If that depreciates, you have to pay more. That is, if it is in a loss, then you have to pay more. Then that transaction, no prohibition, no restriction will be ever imposed. Okay, fine, ma'am. There are some transactions on which prohibition is there. Like, a person resident outside India cannot come to India and invest in chit fund, nidhi companies, or agriculture and plantation activities, or real estate, including the construction of farmhouse. But real estate does not include the development of townships, residential commercial premises, roads, bridge, investment trust, and everything. And TDR. TDR is transferable development right, Now, this is a kind of certificate which is issued by government to us if we want to compulsorily acquire a particular, if government compulsorily acquires a particular property, then it issues us a certificate which is transferable. So we can give this development right to someone else as well. Now, what are the permissible transactions for PRI? They are given in Schedule 1. So PRI, that is, I am a person resident in India, I can invest in foreign securities, subject to all the regulations, okay? I can take loans from outside India. I can get immovable property from outside India. Not get it, but acquire. I can give a guarantee in favor of PROI. Although it is a contingent liability, if PROI doesn't pay, I will pay. So I am creating a kind of my contingent liability, but it is permitted. Now, import or export, although is a matter of current account transaction, yet import export of currency is a matter of capital account transaction. Then, even if I am getting loans in Indian rupee by PROI, that is also a capital account transaction. Maintaining a foreign currency account is also capital account transaction, because there also everything, I have a constant liability created. I have a constant foreign reserve created. Now, foreign currency account, I have told you, we can have RFC account, we can have EEFC account. A person who comes back to India brings a lot of foreign exchange, he can hold it in his RFC account. He can take back whenever he want to. EEFC account, the exchange earners. I am an exporter. I earn a lot of foreign exchange. I'll keep it in my account. I get saved from all that foreign exchange fluctuations. I can use it as and when needed. So these are the foreign currency accounts, which maintaining means capital account transaction. I can get an insurance policy from outside India. I can give loan to PROI. I can remit out of capital assets, or I can enter into derivative contracts like depository receipts. So these are permissible transactions for PRI. Now the same thing, permissible transactions for PRI. They can get securities in India, they can invest in India, they can acquire or transfer immovable property, they can give guarantee in our favor, they can export import currency, they can give deposits, they can hold bank account, foreign currency account in India, they can remit capital assets they can enter into derivatives contract. So everything is exactly the same for PRY also. Okay. Now, after this, we have a section called as Section 8. Which tells us which gives us or imposes a duty on us. If I am an exporter, I have exported goods worth rupees 50,000 USD, then it's my duty that I realize that payment and bring it to India. Right? Government is promoting so much exports, or government is helping so that more foreign exchange reserves come here. So it is my duty that I realize and repatriate. Now, what do you mean by repatriation? Repatriation does not simply mean that bringing into India. You have to bring it into India. You can either sell it to the authorized person, so it gets injected into the system, or you can hold it in your permitted currency account, that is EEFC. So if you hold it in that, that is also meaning repatriation. So you have no non-compliance. Or if I have taken a foreign loan, I collect some payment and I repay that foreign loan, so that government here does not has to extract foreign exchange for repayment of loan. That means government saved its foreign exchange. Any saving is inflow. So inflow as good as repatriation. So these three conditions are all. Okay, now the topic of FDI, that is foreign direct investment. What is foreign direct investment? It is the investment by a person resident outside India. So PROI is making investment in India, right? So when we're talking about investment in India, it could be in an unlisted Indian company or listed Indian company. When we talk about unlisted Indian company, the amount doesn't matter. But when we talk about listed Indian company, the investment has to be 10% or more in post-issue paid-up equity capital. Now, even if it falls below 10% at a later stage, it will still be called as FDI. If it is less than 10%, of course, it is called as a portfolio investment, and it is not called as a foreign direct investment, because direct investment is always about acquiring control, which cannot be acquired unless it is at least 10% or more, right? Now, we have certain prohibited sectors wherein FDI is not permitted, which includes your lottery business, whether it is a private lottery or it is a government lottery, gambling, betting like things, chit fund, nidhi companies, TDR, that is transferable development rights, you cannot trade in that. Real estate business or construction of farmhouses, then you also have about manufacturing of cigars, tobacco and like products. Sectors which are not open to private sector or private investment, they're also not open for FDI, like atomic energy, railway operations and investment by Bangladesh or Pakistan. In fact, I would say there is a quick update on FDI. What is that update, ma'am? Now, any entity, any resident, any entity, if belongs to a country which shares a land border with India, they need prior government approval before making this investment. Okay. Now, what is the procedure for receiving FDI? So we have two formats. We have automatic route, which requires prior approval of RBI government, and we have a direct route. Automatic route does not require prior approval, and approval route, undoubtedly, as the name suggests, needs prior government approval. So whatever is the concerned ministry, it shall give the approval, and thereafter you can proceed with the FDI. Okay. Now, we have the sectoral caps also. What is sectoral caps? Depending upon every sector, there is a sectoral cap which has been given, like maybe it is said that 49% is allowed for approval route, so that is the sectoral cap for approval route, right? Or maybe total 72% FDI is permitted. So if that is said, you cannot go beyond that percentage. So you can go only whatever is the total investment, 72% can come from an FDI source. That is the sectoral cap in that particular sector, right? So we have different caps. We don't have to read those caps in our syllabus. Okay. Now, as we move further, we have permitted investments by PROI. So there are certain permitted investments and there are certain respective annexures which have been given over here. That means if you want to subscribe to capital instruments of Indian company, you may according to annexure 1, right? If you want to purchase or sell instrument of listed Indian company on the recognized stock exchange, then of course you have annexure 2 for the same. The conditions have been laid down and the procedures have been laid down. So as per the directions which have been laid out, you can do that, right? Then purchase by NRI or OCI, that is overseas citizen of India, on repatriation basis, annexure 3. Purchase by NRI or OCI on contribution to capital of LLP, firm, proprietorship or non-repatriation, that comes down to annexure 4. Then securities other than capital instruments, annexure 5. In LLP, annexure 6. By FVCI, that is your venture capital investor, annexure 7. In investment vehicle, annexure 8. Issue or transfer to depository, annexure 9. And ideas, annexure 10. Ma'am, do we need to learn these annexures from examination perspective? My answer would be a yes. You must learn the annexure numbers because we can expect a multiple choice question from this, that maybe in which annexure this particular thing is stated, right? Okay. Now, other than that, we can definitely acquire through rights issue or bonus issue, right? If there is a startup company may issue convertible notes, that we have read under the chapter of deposits also, that if a startup company issues convertible notes for an amount of 25 lakhs, then that will not be considered as deposits. So that is something which is allowed. If the companies are being merged, right, then of course maybe issuance of share happens through to an outside source. So that is something which is allowed, right? In all these situations, you have to conform to the pricing guidelines which have been issued. Now, we also have certain conditions for exit. exit, what other, see, if I have an option to invest in India, I also should have an option to exit, like divest, right? If investment, the opposite of investment is what? Divestment, right? So you may also go for an exit. Is it allowed? Of course, it is allowed. But when you exit, that means you are selling your securities. When you're selling your securities, the biggest problem that comes is valuation. So valuation will be subject to RBI guidelines and, of course, payment of tax, capital gains, whatever is applicable. Okay. So foreign entity refuses to take shares, it can be sold to third party. The problem comes in pricing in case of unlisted companies. So independent valuation by reliable agency subject to RBI guidelines and tax, income tax shall be there. In capital instrument held by another Indian company which has received FDI may be transferred to PROI subject to reporting requirements. So this is a general thing which we know. Okay, moving to the next part, that is external commercial borrowings. Now, what are external commercial borrowings? Ideally, it includes the trade credits also, which we have to read about. External commercial borrowings is borrowings for a commercial purpose from an outside source, right? So this is raised by resident entities from outside entities. So we have some eligible entities who can raise commercial loans from an outside source, and we have some eligible lenders also, right? Recognized permitted lenders. Now the purposes are also specified in this master direction, that for what purposes you can use this loan. So we have permitted users, we have non-permitted users, we have maximum all-in cost ceiling, that is the maximum cost which may be charged for this particular purpose, right? So all this type we have to read. We have two types of ECB. One is FCY denominated ECB, that is foreign currency denominated ECB, and then INR denominated ECB. FCY, which we are taking in foreign currency, INR, which we're taking in Indian rupee. That may also be the case. Okay, it includes the trade credits, but we will read about the trade credits later. Trade credits beyond 3 years are actually ECBs, but trade credits up to 3 years have a different guideline, although they come under the same master direction. Okay, now, who is eligible borrower? Entities which are eligible to receive FDI are also eligible to receive ECB. However, when we talk about INR denominated ECB, all entities which can receive FDI can receive FCY ECB and can also receive INR ECB, plus microfinance and NPOs can receive additionally INR ECB. Okay. Lender. Who is eligible lender? So lender should be a resident of FATF or IOSCO compliant country. That is something which you must remember. MAMP is minimum average maturity period. That is 5 years. You have to remember this, and you only have to remember about 5 years, although there are in-depth workings, more workings, but about which you haven't been taught, and this has not been incorporated much in your syllabus. So I wouldn't say that you go into those much details when you're revising this particular topic. All you can remember is minimum average maturity period is 5 years. Now, for what uses? We have a negative list. You can take ECB, but ECB proceeds, whatever money you're getting from that loan, you're not going to use that for real estate, for investment in capital market, for equity investment, for capital purposes, working capital purposes, except what is permitted. For general corporate purposes, except what is permitted. For repayment of rupee loan, that means you have taken a rupee loan, you're taking ECB and then you're repaying that rupee loan. No, that is not going to happen. Okay, then we come to parking of ECB. What is parking of ECB? Supposedly we have raised a loan, but we have a few months to spend that particular loan, to spend that particular amount. Till that time, it has to be parked somewhere. You cannot keep it at your home, right? So how do you park that ECB proceeds? Now we have two ECB, FCY or rupee, right? So if you want to park it abroad, so ECB proceeds which are meant for foreign currency expenditure can be parked abroad. No problem at all. If you want to park domestically, then whatever ECB proceeds are meant for rupee expenditure, they have to be repatriated immediately to India, and you can keep it with your AD category 1 banks. Okay. that rupee banks that you have, and but this has to be for a maximum period of 12 months only. Remember these details for a maximum period of 12 months. Okay. Now we also have certain reporting requirements. What are the reporting requirements, ma'am? In this, you have to read and understand the concept of untraceable entity. Okay, what is untraceable entity? See, if there is any borrower, he has raised ECB, but the entity, or you can say the auditor, the director, they're not reachable, they're not responsive, they're not replying over the mails, over the calls, over the letters, and it is for a period of at least 2 quarters, right? So that becomes an untraceable entity. Okay, now borrowings under ECB, you have to go for some monthly requirements. That means monthly reporting, and entry not operative on MISIT, entry not submitted auditor certificate for 2 years or more, revised ECB with untraceable entity on top, no fresh application by entity to be processed. In such case, no fresh application will be processed, you know that, right? So AD Bank will not entertain your fresh application for ECB if you are an untraceable entity. Okay, ED to be informed. ED, what is ED? Enforcement Directorate. So if any entity is found to be untraceable, if any entity is recognized as untraceable entity, then Enforcement Directorate will be informed when the entity is designated as such, and there will be no remittance to such entity under automatic route. So if you want any inward remittance, then that has to be permitted through approval. You have to take approval for the same. Okay, fine. We also have something called as refinancing of ECB. What is refinancing of ECB? Refinancing of existing ECB. That means maybe it has matured, but you want to refinance it, right? So what is important and what you should remember is that your outstanding maturity of original borrowing is not reduced, and all-in cost fresh ECB is lower than the all-in cost of existing ECB. Okay, then only you will refinance, right? Then comes your point of conversion of ECB into equity. Supposedly your ECB is matured, but it is not paid. Then what can happen? Then maybe that ECB, supposedly someone has given us loan and we are unable to repay that loan. So what we can do is we can offer them equity. The same thing is given here also. Okay. But what is needed is, if it is covered under automatic route, great. If approval is needed, then you'll take approval. So it depends which sector do you follow in. Can they invest? Because you are taking a loan from an outside source. So from that source, if you are converting your loan into equity, that means it is resulting into FDI. So we have to check FDI norms. Is it permitted? Does it come under automatic route? So accordingly we'll do that, right? Then comes your security for raising ECB. If you have taken a loan, you ought to provide security. So AD category 1 banks are allowed. They can create a charge on your assets, immovable, movable, any securities, personal guarantees, whatever it be, in the favor of overseas lender. Okay, then we come to the topic of trade credits. What is trade credit? Trade credit is the credit which is provided for import of goods. You are importing a particular good. It may be a capital good, it may be a non-capital good, and you are importing this particular good. You need, what do you need? You need credit. Just like we take goods over here in India, we might be needing credit, right? And we are being provided credit by the shopkeepers or by the banks, whatever. So here also the same thing is happening. You have two types of credit. One is buyer's credit and one is supplier's credit. Supplier's credit means whoever your supplier is, that is going to provide you the credit because you're importing a good from him. Right, so he is giving you credit, so that's an incentive from for you to take goods or import goods from him only. Right, so it adds as an advantage to the supplier also. Okay. So it refers to the credits extended by the overseas supplier. That is called as supplier's credit. And if it is extended by bank or other financial institution or other recognized lenders, then that is known as buyer's credit. So we have two types of credit. Who is eligible borrower? The person resident in India who is importing the goods. Okay. Now we have a limit amount under automatic route. 150 million USD per import. Okay. For oil, gas, refining and marketing and airline and shipping companies. For others, it is 50 million USD per import transaction. Recognized lender, I have already told you. The period of trade credit, this is also something which you must learn and remember. Period of trade credit, it is going to be up to 3 years for import of capital goods, and for non-capital goods 1 year or operating cycle, whichever is less. So for import of non-capital goods, you have to ensure what is your operating cycle. If it is 8 months, then 1 year or 8 months, whichever is less. So it comes out to be 8 months. Right. So within 8 months, that trade credit should be paid. That amount should be paid in case of non-capital goods. And in case of capital goods, it is going to be 3 years. Beyond 3 years, trade credits don't exist. It has an upper ceiling. Beyond 3 years, if you are taking even for your imports, then it falls under the category of ECB. Okay. But for shipyards and shipbuilders, even if you're importing non-capital goods, the period can go up to 3 years. All-in cost ceiling benchmark rate plus 300 BPS, and for your INR denominated trade credit, benchmark rate plus 250 BPS. Forget this. This is for existing one. I'm not even telling you this again. Okay. Now, hedging is also permitted. I hope you understand what hedging is. I have explained you in the class also. If that is why, if you're taking a foreign currency denominated trade credit, maybe you're taking trade credit from a place and thereby you're converting it. Maybe you are taking that advantage of currency exchange or whatever it be. So that is something which is possible, and hence you can exchange the currency also, and accordingly, according to the terms, according to your approved management policy, you can go for hedging also, and you can go for change of currency also. But FCY to INR is permitted, INR to FCY is not permitted. For trade credits in SEZ, let me take you to another point over here. Your IFSCs are also considered as a foreign zone, right? Hope you understand that. So if you are taking trade credit from that, that is also covered over here, but they have a separate guideline. So trade credit can be used by unit or a developer in SEZ, including FTWZ for purchase of non-capital and capital goods within an SEZ, subject to compliance with the parameters given above. So the same parameters, any entity in DTA, that is domestic tariff area, which I'm talking about, is also allowed to raise trade credit from a unit or a developer of SEZ, including FTWZ. So you can also do that. Not very important or not much important. Now we come to security for trade credit. Security may be given. For that, you must have a security clause in the loan agreement. There should be no objection certificate from the existing lenders in India. Right? Your agreement should be coterminous with the underlying trade credit. It should not be that your trade credit has different terms and your agreement has different terms. And in case it has to be invoked, then whatever payment you are making towards guarantee, it is no way going to exceed your amount of trade credit. Now we have some reporting requirements. What is the reporting requirement here? AD category 1 banks come into play and play a major role. AD1 category banks, you have to do some monthly reporting. Reporting of what? Details like trade credit, its drawal, utilization, and all that too. Director, Division of International Trade and Finance, Department of Economic and Research each month. Then there has to be quarterly reporting about issuance of bank guarantees for trade credits. You also have a role. What role? See, you have to ensure that whatever trade credit is being transacted, is being taken, it complies with the parameters of the policy and FEMA. You also have to ensure that there shouldn't be double financing on a particular import. You also have to ensure that when we are importing non-capital goods, you have to check the period. Trade credit period cannot extend beyond 1 year or operating cycle, whichever is less. In case of capital goods, undoubtedly we have a period of 3 years, so straight away banks can check that okay fine, it is within 3 years, trade credit is fine. But in case of non capital goods, it may depend upon entity to entity, so you have to check their operating cycle and ensure that the trade credit falls within that particular period, right? Okay. Okay, let's now revise the chapter of Banking Regulation Act 1949. The first thing that we need to know before we read the act is some brief history, right? So what history is very important is that which was the first bank which is still in existence, that is SBI. Now, was it SBI? No, it was ideally Bank of Calcutta, which was renamed as Bank of Bengal. Then two other banks came, all three were merged, they became Imperial Bank, and thereafter SBI came into picture. Right, so we have SBI, which is the oldest bank. Of course, it is all governed by RBI, right? All the banking sector comes under RBI. If I talk about the banking sector, it has been classified into two types of banks: scheduled banks and non-scheduled banks. What are scheduled banks? Which come under the second schedule of RBI, right? We can say that further scheduled banks have been classified as nationalized, are the private sector, regional, rural, foreign, etc., etc. Now, what do banks do in general? Banks accept deposit and lend loans. There can be different forms like savings bank, current, FD, RD, cash certificate. The very first section that we read in this act, prima facie, is section number 6, which talks about the different forms or different forms of business in which the banking companies may engage. What are the different forms of business? They can be the agent, insure, guarantee, underwrite, transact every kind of guarantee or indemnity business. They can sell or realize their claims. They can hold the property. They can execute trust. They can undertake things relating to lease, right? And then they may undertake any business, right, or do anything which is incidental to their business, to the promotion or advancement of their business. Now, although this list is exhaustive, but it is not comprehensive. That means it contains everything, but it has not been given in detail. So we have a lot of hidden services or general utility services which are being performed by banks, which can be a part. Like I discussed with you, we have locker facility. Now, section different sections, section 18, section 42. Prima facie, we have two basic requirements of SLR and CRR. What is it? Every bank accept deposits. Now, whatever deposits banks are accepting is liability from bank's perspective. And there are two types of liabilities. One is demand liabilities and the other is time liabilities. Demand liabilities that we have to pay as and when demanded, and time liability which is for a fixed period like fixed deposits. Demand liabilities like savings bank. Now, whatever are your total deposits, that is your time and demand liabilities, net demand and time liabilities, a certain percentage of that has to be kept with RBI in a current account opened with RBI on which you do not get any interest. That is known as cash reserve ratio, and a certain portion or certain percentage has to be kept in liquid assets. I am writing it over here, 4.5 and 18.5. You write this, although this is not at all needed, right? I have told you different ratios, different percentage. The current percentages are not asked, but still you can write this, right? They have to be maintained in liquid assets. Liquid assets means what? Maybe gold or maybe some investments or securities which are approved, right? So that they are readily available as cash. So whatever you receive, you have to keep certain portion as CRR, certain as SLR, certain as other statutory requirements, certain you have to transfer to reserve fund also. Then you have to keep for your day-to-day expenses, and then whatever is available can be given as loans. We have an important set with respect to board of directors. At least 51% of the person should have specialized knowledge. Specialized knowledge in what field? Accountancy, agriculture, banking, finance, law, small scale industry, or any field which, in the opinion of RBI, has relevance in the banking sector. Okay. Now the directors and other than chairman and WTD are going to hold office for 8 years and others for 5 years. Who can become the chairman? The chairman can be the whole-time member, whole-time director or part-time director as well. In case he is the whole-time director, he's entrusted with all the responsibilities. In case he's part-time, then we have managing director which comes into picture and he's entrusted with all the responsibilities. Okay, so Reserve Bank has the power to appoint that. Then we have something with respect to capital. Now, Section 11 prescribes the requirement of minimum capital by a banking company, which we don't have to study. But Section 12 provides something more, which is that subscribed capital should be more than equal to half of authorized capital and paid up capital should be more than equal to half of subscribed capital. So this is something that you have to learn. Whenever there is any change, you are being given a buffer of 2 years to bring it back into the same proportion. With respect to capital, we also have something called as Basel III norms, right? For that, what all things are needed? First is the capital adequacy ratio. Now, capital adequacy ratio, of course, is very important with and is also being forced to provide for NPAs, right? What is the capital adequacy ratio? The minimum capital that you have to maintain in comparison of your risk-weighted assets. Indian commercial banks have been instructed to comply with Basel III recommendations. So I told you about Basel III recommendations. We had Basel 1, Basel 2, and then Basel 3. Now in Basel 3 recommendations, you have to be compliant. A minimum total capital of 9% of your total risk-weighted assets. But apart from that, you must also maintain buffer when you have good period. That means if you have when you have a better capital quality, then you must maintain buffer to deal with the times when you have stressed assets more, right? So that is something which must be kept in mind. You cannot pay dividend unless your capitalized expenses have been written off. This is the main thing. The other things are not there, right? This is not there. What is important is until your capitalized expenses are being paid off. Even if depreciation or other things are not paid off, you can still pay dividend unless your capitalized expenses are written off. That means preliminary expenses, commission on issue of shares, brokerage, and all that. Then you have to transfer at least 20% of net profit each year to reserve fund. Scheduled commercial banks, 25%. Certain restrictions. Banking companies cannot invest in other companies so as to acquire a controlling interest. That means you cannot make someone else your subsidiary. Only if it is necessary and you take RBI's approval, then only you can form someone as your subsidiary. Otherwise, it is not allowed. Okay. Moreover, restriction on loans to the director or to the firm in which director is interested or to some guarantor of director, it is not allowed. Moreover, we have other restrictions that RBI can give directions on certain matters, that for what purpose you can give advance, the margin that you might have to maintain, the rate of interest that you charge, or the maximum amount that you can give, right? Then we have something called as license of banking companies. Any banking company which operates has to obtain a license before it can run a banking business. How do you apply for license? You have to make an application to RBI. Now, RBI will inspect certain things. What is the company in a position to pay its claims? Are their affairs not detrimental? And is it in the public interest that we give license? If these conditions are being satisfied, then RBI will grant license. But again, this license may be cancelled. When can it be cancelled? If you do not do banking business, you cease to carry on banking business, or you do not comply with the conditions, then in such a situation, your license will be cancelled. If you are dissatisfied with the decision of RBI, you have 30 days to make an appeal to central government. Apart from this, RBI also has a lot other powers. RBI has the power to control your opening of new business. So if you want to open a new branch, you have to seek RBI's approval. If it is temporary within the same city, it is allowed. If you want to, RBI also has the power to publish information, to give you directions, to remove managerial person if needed, to appoint more directors, or to suspend the board as and when needed. Apart from that, there are various information that you have to furnish to RBI, which are covered in different sections. So I have compiled all of that. Banking companies have to prepare their financials according to third schedule given in the Banking Regulation Act. Although it is a banking company, but it is not required to comply with the format given in Companies Act. The balance sheet P&L for every accounting year, and which is going to be duly audited. And auditor is also required to make additional report on certain matters which are specified in section number 30. That is going to be submitted to RBI. Apart from that, there is various other information in the form of different returns also required to be reported to RBI, like assets and liabilities on last Friday every month, unoperated accounts for 10 years within 30 days, and profit and loss account, balance sheet, audit report that I already told you, right? RBI is also entrusted with the wide powers of inspection. Now we come to suspension of business. We are trying to suspend business. That means nobody is suspending. The banking company itself wants a period of moratorium. That means it wants that no claims and no litigations should be filed against me because I'm unable to discharge my obligations. So if a banking company cannot repay debts, cannot pay or cannot make payments as and when demanded and meet its obligations, it first of all discusses with RBI. RBI makes a report. On the basis of that report, along with an application, we apply to High Court. And High Court gives us a stay for maximum 6 months. That is known as a period of moratorium, when there will be no action taken against the banking company and it will be given certain tenure to revive. Right? Then we have winding up of banking companies. A banking company cannot be wound up voluntarily. Okay, so it is not allowed unless you have RBI's approval. So unless RBI certifies that you will be able to pay every penny, every debt in full, then only voluntarily a banking company can shut its business or operations. Otherwise, by RBI, it can be done on what grounds? If you do not have the license, that means you're disentitled. If you're prohibited to receive deposits, when you cannot receive deposits, you cannot carry on the business of banking. If some compromise has been sanctioned and pursuant to that compromise it is happening, if you're unable to pay debts or in any way your continuance is prejudicial or harmful for the depositors, then in these situations, winding up may happen. And one more thing we have, that is about amalgamation of banking companies, which is allowed on two-way approval, shareholders 2/3 majority voting, and RBI's approval. So once you get these two approval and the scheme of amalgamation is sanctioned, banks may be merged into one another, right? And thereafter assets and everything will be transferred, right? Now, role of RBI. RBI, we all know, is the apex bank, and when we talk about the monetary banking of financial policies, RBI has a major role to play in it. Now, RBI controls the entire banking system or all the banks, but control is not the correct word that we should use. Why? The reason being, in the changing scenario, RBI wants to promote the development of all the banks. So it rather acts as a facilitator, right? Now we have certain functions of RBI. In acting as a facilitator, it also has a department of banking operations and development. So the main focus is to develop the entire banking system, focus on the betterment of its operations, right? Banks have a lot of functions to do, a lot of things to do. They have to expand their branches, they want to merge, they want to liquidate, they want to reconstruct. In all these process, RBI plays a major role. So it makes the regulations, it prescribes the compliances, it oversees everything. So first is the regulatory role. RBI has a regulatory role to play for commercial banks as well as for local area banks. Secondly, under Banking Regulation Act, it has been conferred the power to inspect banks, of course, for the betterment. So it has the power to inspect. So inspection is also one of the function. Third, anti-money laundering and combating financing of terrorism. So when people generate money by a crime, that is the proceeds of crime, and thereafter that is being used for terrorism, all this process is very toxic for the nation and must be prevented. And who does it? Who ensures to do that? It's the RBI. Okay, next is its appointments division. See, RBI has a lot of divisions or departments or cells, you whatever you call it, right? So RBI also has an appointments division. An appointments division, we have two things, right? We have private sector banks and public sector banks. When we're talking about the private sector banks, whatever appointments are being made as MD, chairman, the proposals are being sent to RBI and RBI approves the same. When we talk about the public sector banks, RBI makes recommendation to government regarding appointment of those, their payment, their salaries and everything. Then we have licensing of branches. Whenever any bank wants to open up a new branch, close down the existing ones, shift, or all that part is being done by RBI. So RBI grants approval or authorization to commercial banks for doing the same. Then we have banking policy. See, the policies, whatever have been made, are also important to be reviewed. So, first, you make new prudential norms. Second, review the existing ones. They both have to be done. Ma'am, policy or guidelines in respect of what? In respect of capital adequacy, in respect of income recognition, asset classification, then capital structure, risk management, implementation of Basel framework, settlement of NPAs, FCRA matters, that is Foreign Contribution Regulation Acts matter. So all that. Issue of directives. See, again, under Banking Regulation Act Section 21, RBI has the power to give directions to the banks, right? In respect of what? In respect of the accounts. Deposit, SB accounts, payment of interest, payment of additional interest, additional brokerage. Then we also have a defaulters list cell under RBI. Defaulters list, as the name suggests, it is going to make and prepare and update the database with respect to defaulters. So from where RBI gets this information? From all India financial institutions. It gets the information about the defaulting borrowers and categorizing it into different categories. So willful defaulters of 1 crore and above, 25 lakh and above. So likewise, all the defaulters are being, the information is being collected and disseminated. Then we have an international banking section, and all the 3 points get covered in that international banking section only. First, Indian banks are operating abroad or outside banks are operating in India. In both the cases, you need some policies, you need some set of guidelines, you need some approvals as and when needed. So all that is being done by RBI. RBI also grant approval for dealing in precious metals and about the policy matters relating to the same. Then we also have some banking branches which are being opened in special economic zones. They are called as offshore banking units. So their approvals are also being given by RBI. Then we have industrial and export credit section. It operates through 3 desks: policy desk, export credit desk, and industrial rehabilitation desk. So policy risk related to policy, export credit, exim and all that, industrial rehabilitation, whatever units are being sick, giving concession to them and all that. Then we have a legislation section. Legislation section has 2 points involved. One is it interprets the law. The law means Banking Regulation Act, RBI Act, and all other associated rules. Second, a bank sends an application for getting exemption from various provisions of Banking Regulation Act. So application is being sent to RBI, but that is being processed by this legislation section only. Then comes your role in management of foreign exchange. Now again, when we are talking about foreign exchange, we have two types of transactions. One is capital account transaction, the other is current account transaction. When we talk about the current account transactions, RBI cannot impose restrictions. RBI does not have the power to do so. However, central government can impose restrictions, but central government imposes these restrictions in consultation with RBI. And RBI just consults the government for that respect. However, there are certain current account transactions for which it is written that you need RBI approval. So for that, RBI will grant the approval. But otherwise, RBI cannot impose restrictions on current account transactions. However, when we talk about capital account transactions, then it has the power to regulate, prohibit, and restrict certain type of transactions by making regulations for the same, like transfer or issue of foreign security. Okay, like you are transferring foreign security to a resident, or borrowing or lending in foreign exchange, export import of currency notes, transfer of immovable property outside India. So these are certain transactions which can be regulated, which can be prohibited, or which can be restricted by RBI by making respective regulations. Then whenever you're making an export, then that export, the proceeds of that export must be realized back to India, right? That is being again covered or within the function of RBI. RBI also has the function to grant exemption that, okay, fine, you don't have to realize the money. The section 9 of FEMA. And whenever we want foreign exchange, we have to go to authorized person. Now, this authorized person gets authorization from RBI only. Apart from that, RBI acts as a bank to the commercial banks. That means it gives loan to bank also and to government also, and it also oversees the payment and settlement system of commercial banks. Okay, let's now revise the chapter of SARFAESI. Now, this particular chapter, if we see the full form, securitization and reconstruction of financial asset and enforcement of security interest. So, the name itself involves the three most important elements contained in the chapter: securitization, asset reconstruction, and enforcement of security interest. This act gives the power to banks if they lend money to someone and they default in repayment, right? In such a situation, how can banks recover their money? Of course, they have IBC as a financial creditor. They can make application under IBC subject to fulfillment of other conditions. But they also have some right under SARFAESI Act. So banks, if they want to recover their non-performing assets, the loans that they have granted were not repaying, they have been recognized as substandard loss or doubtful asset, or they fall in the NPA category. To recover that, one very important right that banks have been conferred upon under this act is enforcement of security interest given under section number 13. What is enforcement of security interest? It is like whatever security bank has, that secured asset can be sold and your money can be realized towards payment of your dues, right? Other two things, securitization and asset reconstruction. Ideally, banks have NPA, but it is very tedious job and very difficult for the banks to recover the same, because banks have a lot of other functions to discharge. So this act incorporates, establishes a new type of company, which is asset reconstruction company. Ideally, it is a type of financial institution, not a bank, but regulated by RBI and registered also under RBI. So this company helps the banks to recover NPAs. How it helps? We have methods of asset reconstruction. That means the loan through asset reconstruction company can be reconstructed. Maybe their payment can be rescheduled. Maybe if the borrower, the one who has taken loan, that is the company who has borrowed loan, maybe they are not performing well because of the management, and that's why the creditors are suffering. So management can be taken over and the payment can be realized by the asset reconstruction company. We also have something called as securitization, where what happens on the basis of that secured asset, the security that has been given to banks, on the basis of that, asset reconstruction company raises money from qualified buyers by issuing them security receipts. From that money, of course, that payment can be made to the banks or the secured creditors, and eventually it can be recovered by the asset reconstruction company. So these are the general meaning of the terms. We also have other important definitions, which of course you'll go through. The first section that we read in this chapter is section number 3, which talks about registration of asset reconstruction company. So any company which wants to do the business of asset reconstruction or securitization has to get itself registered. They must have minimum net owned funds 100 crore, that is prescribed, and certificate of registration. How do you get certificate of registration? You have to give an application in the prescribed manner to RBI. RBI will inspect your application and see whether the conditions are being complied with or not. What are the conditions? No loss in preceding 3 financial years. Adequate arrangement. How are you going to recover? How are you going to realize the financial assets that you will eventually buy? Adequate experience of the directors. No offense by directors involving moral turpitude. The sponsor should be fit and proper. We also have proper RBI guidelines to determine whether a person is fit or not. Who is a sponsor? Sponsor is someone who has more than equal to 10% equity in the company. Okay. And compliance with prudential norms. So if everything is satisfied, certificate is granted by Reserve Bank. But even if certificate is granted, it can be cancelled under section number 4. However, if the conditions are not complied with, RBI will give an opportunity of being heard and reject the application. If you become asset reconstruction company, if you get that certificate, then 3 things require prior approval of RBI. Your substantial change in management, your change in registered office, and your change in name. All these 3 require approval of RBI. Now, if you have got that certificate, but later on you cease to do that business, or there is no investment of qualified buyer, or you do not comply with some condition or direction, you don't maintain the books as you are supposed to, you don't produce the books for inspection, or you change your name, registered office or management without approval of RBI, then in all these situations, your certificate may be cancelled. Of course, opportunity will be given to fulfill the conditions, and if you're dissatisfied with the order, you can appeal to central government within 30 days. Right? Now, whenever asset reconstruction company want to acquire this right or interest in the financial asset, they can do so by making the payment or by issuing the debentures, by entering into an agreement. What happens is the bank is transferring the financial asset in your name. That means all the legal formalities need to be done again. All the legal documents will be prepared again, which involves a lot of stamp duty. But here the stamp duty will be exempted. So if you are taking that financial asset for asset reconstruction or securitization, then no stamp duty. Apart from that, if you're taking, then of course there will be stamp duty, right? Okay. Now, banks or financial institutions, how do they transfer financial interest? Once they transfer, they give a notice to the obligor. If they pay, great. If they do not pay, then they have to pay to asset reconstruction company or not to the bank, because the asset has been transferred. Right? Very simple thing. Now, this is ideally securitization. After acquiring financial asset, ARC may offer security receipts to qualified buyers, raise funds, and they have to maintain separate accounts for every scheme. Whatever amount they realize from the loan, they have to utilize towards repaying the money that you have borrowed from qualified buyers. That is towards redemption of investments. If you do not do that, they can call a meeting and take adequate action. Then comes the section number 9, measures for asset reconstruction. So these are the methods by which asset may be reconstructed. Now you have to remember one thing, that asset reconstruction or taking these measures is not something which is very easy. RBI has made policies, regulations with respect to each one of them. Okay, so if we want to do that, we have to comply with all the conditions that have been imposed by RBI, and thereafter we can do that. If we do not comply with the regulations or policies, then application against us can be made to Debt Recovery Tribunal. Okay, what are the measures of asset reconstruction? ARC, Asset Reconstruction Company, may take over the management, may sell some part, may lease some part, may reschedule the payment, may enforce their security interest as banks do on their own, may settle the dues at a lesser amount, may take possession of the secured asset, or may convert your debt into equity. Right? So they can take some shares of the company and let go of your debt. So that can also happen. Now, they can also act as agent, they can also act as manager or receiver, but they can do so if they take approval from RBI. So there are other functions also of asset reconstruction company which may be undertaken. We have a very small section, section number 11, which talks about the resolution of disputes. Okay, so if any dispute occurs, it is not going to be referred to any court, it will be taken through to arbitration. Okay. Now we have other sections where powers of RBI have been determined. So RBI has the power to determine policy, issue directions, call for statement, information, audit, inspection. All these are small sections that we have. Now another important section, section number 13, enforcement of security interest. Okay, so banks have this right under the Act. They do not have to take any permission from court or tribunal. So they do not intervene when you are enforcing the same. When can you enforce the same? When the borrower defaults. Now, the default does not mean one non-payment. It means if you have classified them as NPA or you have given them a notice and they have not made the payment within 90 days. So then default happens. So if you have defaulted, you have adequately recognized them as NPA, then you can send a written notice to the borrower. Now the written notice will state, this is the amount payable. If you do not pay within 60 days, we will enforce our security interest. That means we will enforce any of the rights which have been conferred to us in section 13, subsection 4. There are 4 points given. Okay, so if you do not pay, this is going to happen. This may happen, right? Borrower pays, great. Borrower doesn't pay, this will happen. Borrower also has a right to raise representation or objection. So if he raises, it may be accepted by the bank or the lender. It may be rejected. If it is accepted, then we'll work accordingly. If it is rejected, then you cannot go anywhere and appeal. You have been communicated the reason for the same, right? So what are the consequences that are given in section 13(4), ma'am? Secured creditor can take possession of secured asset. They can take over the management. They can appoint a manager to manage the asset. And one more point, what they can do is, supposedly borrower has a building, borrower has mortgaged this building and took a loan. They are unable to repay the loan, so that building becomes the secured asset of the bank. Right. Now, bank wants to enforce the security interest. That means bank might take possession of the building. That building is occupied by some people who pay lease rental to the borrower. Bank can give a notice to that lessee and instruct them that now you are not going to pay lease rental to them, you are going to pay lease rental to. So this can also happen. This is also one of the methods which are given. Okay. Apart from that, if secured creditor is trying to sell an immovable property and you have a reserve price, that means minimum price, and no bidding takes place at a minimum price or over that price, then secured creditor himself can also bid and take the property. Okay, so that is something which can also happen. Now, one important thing in section number 13 is that till, that means before the date of publication of notice of public auction or inviting any quotation, even before that, if payment is made, then the sale can stop. Then no sale will take place of the secured asset. So if you pay even before all that auction, then also no action will be taken. Whatever action has been taken, no further action will be taken. Right? Okay. Now we have section number 15, which tells us the manner of takeover of management. Who takes over management? There are two persons. One, the secured creditor. When they want to enforce their security interest, they can also take over the management. Secondly, the asset reconstruction company, when tries to reconstruct assets, then they can take over the management. In both these situations, what they're trying to do is they're trying to recover their loan. For that, they believe that management is acting in such a way which is not beneficial for the creditors. Hence, we must intervene and we must manage the company in such a way that we are able to recover our dues. So they will take over the management for only that tenure till they realize their debt in full. After that, the management will be restored. Okay. So in such a situation, what happens? If the borrower is a company, the secured creditor, that is the bank or asset reconstruction company, they take over the management, they remove the directors. All the directors, existing directors, will vacate office and they will appoint the directors, as many as needed. The directors who vacate the office will not be entitled for any compensation. Okay. During this takeover time, the powers of shareholders are also put on hold. They cannot pass a resolution and appoint some director, or they cannot pass an order of winding up unless they take approval from the secured creditor. Okay, after that we have something called as appeals. If you're dissatisfied, the borrower is not happy with the way this takeover is happening, or with the way the measures of asset reconstruction or anything is taking place, if you're dissatisfied, within 45 days you can appeal to Debt Recovery Tribunal. Okay. Now, Debt Recovery Tribunal might think and believe that yes, the secured creditor or maybe the asset reconstruction company is trying to exploit you. They are not doing these measures according to the policy. So they will ask to restore, or maybe ask to the secured creditor back to the borrower, something like that, or other order. If you're still aggrieved, or maybe the order is not passed in your favor, or no order is passed in 4 months, then within 30 days you can appeal to DRAT, that is Debt Recovery Appellate Tribunal. For that, you have to deposit at least 50% of the amount due. You may request the appellate tribunal and they can reduce this amount to 25%. Clear? Fine. Okay, let's now revise the chapter of Insurance Act and thereafter era. Insurance, what is insurance? It is basically spreading the risk over a large number of people, right? So ideally, the individual, whatever loss he might suffer, whatever risk he has, that is being spread over a number of people. How it is spread? By entering into a contractual arrangement with a company of transferring risk. So we have two parties involved in this contract of insurance. One is the insured and other is the insurer. That is the insurance company. Insurance company provides the risk cover and the insured pays the premium against the same. Right. Till 1912, we did not had any insurance law, and all the insurance companies were governed by uh, Companies Act only. But later on, undoubtedly, we formed insurance law and it was introduced. Now, today we have Insurance Act, undoubtedly, we also have ADA, but apart from that, we also have LIC Act, we also have Marine Insurance Act, and we also have General Insurance Business Nationalization Act. So, all these were also passed, which continues to stay. Now, one more thing is very important that you have to keep this in mind. You can write it somewhere. FDI in insurance sector. Now, earlier FDI in insurance sector was allowed only up to 26% through automatic route. This has been enhanced to 49% under automatic route. We know that we can attract foreign people or foreign investments into different businesses that we Indians carry on. One of the businesses is insurance. Now, does government permit foreign people to intrude into this business? The answer is yes. We have two routes of FDI. One is automatic route and other is approval route. Automatic route, that means you will not be needing the permissions, and straight away by complying with all the requirements, you can enter and you can start with the business, right? Or you can invest. So under automatic route, earlier FDI was allowed only up to 26%. Now it is allowed up to 49%. We have different types of insurance. If I broadly classify, I can classify into three categories: life insurance, general insurance, and health insurance. Although health insurance is a part of general insurance, however, it has been differently classified because it has been differently defined also. So we have a separate definition. General insurance includes the all other asset, general, fire, marine, miscellaneous, plant and machinery. All that insurance is general insurance, right? So insurance companies spread the risk among a large number of people and to make small premiums as against the coverage. What can you insure? You can insure anything in which you have insurable interest, which goes as the first principle of insurance law. What is insurable interest? We have different types of interest. We have security interest, we have absolute interest. Likewise, we also have insurable interest. Insurable interest in any property means if damage happens to this property, I will suffer pecuniary or monetary or financial loss. If I don't suffer any loss, I don't have insurable interest in this property and I cannot get it insured. If I have a car and the car damages, I will suffer monetary loss. So I have insurable interest in that car. Even if I'm not the owner of the car, I have taken it on lease, then it brings I am a taxi driver, it brings me money. So I have an insurable interest in that, right? So it is important that you have an insurable interest in the property. Okay. Now, the second thing comes to be good faith, utmost good faith. What is utmost good faith? You can remember the maxim, of course. It means basically honesty. Both the parties involved in this contract of insurance have to observe good faith and honesty towards each other and make adequate and full disclosure of all the material things required. Whatever information you are exchanging, that has to be true and correct. If it is incorrect or if you try to hide some material information, that means you have not acted in good faith and then the contract may be avoided. Then we come to representation, but before representation, misrepresentation, we have to understand what representation is. Representation is any statement which is made by one party to the other. It may be implied, it may be expressed, whatever it is. Now, representation, if they are an integral part of the contract, that means if you say something which is the basis of the contract, then that becomes a warranty. And if that is not complied with, then the contract is avoided, right? But if it is not an integral part of the contract, not so material, then we have to see first thing whether it was willful or it was innocent. Secondly, what is the how much has it affected the contract, right? So then it can be avoided, or then it can be turned out to be void. Please strike this, because this will only create confusion to you. You have to remember that life insurance policies cannot be questioned after 3 years of commencement. See, if I have obtained any insurance policy on providing incorrect information on the basis of fraud, then of course whenever the fraud is discovered, that the contract can be avoided, right? But if it is a life insurance policy and I have obtained it on the basis of fraud also, then insurance companies have only 3 years to check this, to inspect this, to identify whether the other person is lying about something, or etc., and avoid the contract. If they cannot do that after 3 years, it is not going to be questioned. Okay, after 3 years. So within 3 years of commencement of policy, you can question life insurance policy, not after that. Then comes your condition. Condition is something that you put on the basis of which policy is granted. So some conditions are precedent, some conditions are subsequent. Conditions precedent, if you don't fulfill this, if you don't pay the premium, if you don't do this, then of course the contract is void. Even if we have entered into a contract, it is not valid. And condition subsequent, that after this you have to do this. If you do not do that, then of course the contract will be avoided. Okay, so conditions are general things. Then we have indemnity and subrogation. Indemnity is making good the loss. Life insurance, you can never make good the loss. If someone has died, you cannot never replace that person, right? So it is not a contract of indemnity. Others are a contract of indemnity. So you make good the loss. And subrogation, what do you mean by subrogation? Subrogation is ideally a right that allows someone else to make the payment. That means I have, maybe I entered into any accident, and I am liable to this third party, but I'm not making the payment. It is the insurance company which is making the payment. So subrogation is the legal right that allows the insurance company to make the payment. Now, whenever I'm saying indemnification means I'm making good the loss of the other party. Supposedly, the other party has taken a cargo insurance and the cargo is lost. The cargo is worth ₹1 crore, but you have taken an insurance policy of only 10 lakhs. So undoubtedly, your loss will not be made good, right? So it is subject to certain conditions, what policy you have taken. And supposedly you have taken a policy of 1 crore, but then your loss is only 10 lakhs. So you will get only 10 lakhs. So these things have to be considered. Although we say that we put the insured in the same position as he was, but again subject to these things. Then comes your proximate cause. Proximate cause means what? It is the nearest cause. Any mishap which occurs may be because of number of things or number of series which happens. Fire was caught for certain reason. But then if in your insurance policy it is written that because of fire we'll give you the claim. So fire is the nearest cause, and that's why you should get the claim. So we have to check the nearest cause and not the remote cause. Then comes your insurance and consumer protection. Consumer Protection Act covers insurance sector as well. So we, the insured who have taken the insurance policy, whether we are taking it for our business or for our personal life, we are treated as consumers and we have the chance to move to consumer forum for any complaints. However, the insurance companies are not consumers. So if they have any complaint, they have the adequate forum as some civil courts. They cannot move to consumer forum. When do we consider our policy to start or commence? Whatever date is mentioned, whatever time is mentioned. If date is not mentioned, it is governed by the provisions of Indian Contract Act, and whenever the time of acceptance, that is going to be the commencement. If time is not mentioned, we consider it midnight, right? Now we have some other provisions relating to insurance. Point number 1, if we want to take insurance from some foreign insurer, not allowed except with the permission of ADA. ADA is the authority for which we have another act as well. Then comes your requirement as to capital, minimum paid up capital. In case of life insurance or general insurance, 100 CR, health insurance, 100 CR, reinsurance, 200 CR. And if I talk about reinsurance, we have another requirement that you cannot start or you cannot be registered unless you have 5,000 crores net owned funds. Because you are now going to protect the insurance company. That is what reinsurance business is all about, right? Every capital of insurance company will comprise of equity shares, and voting rights will be with the equity shareholders, and the paid up amount will be same for all the shares. Now, insurance companies are also required to prepare their financials according to the format specified in the Act. So they have to prepare balance sheet, P&L, revenue account, and P&L appropriation. Get it audited by the auditor, who shall have the same powers, duties, liabilities, penalty as given under Companies Act, chapter of audit and auditors, right? Whatever audited account and statement they prepare, that is going to be printed and 4 copies furnished to the authority, signed in the specified manner. Actuarial report is for life insurance business. So if you're carrying on life insurance business, once a year you have to carry out the investigation and value your liabilities. So get your liabilities valued by an actuary actually and report according to the regulations. You also have to prepare a record. Record of what? Record of all your policies. Policies, that means whatever you have issued, the names of policy holder, the date when the policy was effected, any transfer, any nomination, everything, and the record of claims. Whoever has claimed, whatever claims have been granted, whatever claims have been rejected, if rejected, on what grounds. Okay, so every record has to be maintained. How? It may be maintained in any form, including electronic form. However, if in the regulations you exceed the specified threshold, then it is going to be in the electronic form only. Right? Okay, then we have investment of assets. So you have to keep your money invested. What amount invested? Liability minus whatever premium is due, whatever you are going to collect. That amount you have to keep invested in assets at all times. In what assets? 25% government securities, 25% in government or other approved securities, and balance in other approved investments. If you are carrying on general insurance business, then 20% in government securities, 10% in government or other approved securities, and balance according to the regulations. Fine? Okay. Then we have investigation and inspection authority, that is IRDA, may at any time direct person to be the investigating officer and investigate the affairs of insurer or intermediary. What do you mean by intermediary? Intermediaries include the surveyors, loss assessors, and brokers, and everyone. We have 3 people involved in the chain, right? So we have the insurance company, we have the surveyors, loss assessors, and other people, and we also have insurance agents who solicit and procure the insurance business, right? Okay. Now the investigating officer will investigate. So it will be the duty of the insurance company or the intermediary to produce all the books of accounts, registers, documents, everything, and provide full assistance and cooperation to the investigating officer to let him carry out the investigation. Once he carries out the investigation, he will make the report to the authority. Any insurance company cannot pay any commission to any person other than insurance agents or the intermediaries. Okay, that means, can the insurance companies appoint insurance agent? The answer is yes, you can appoint insurance agent to procure business, but one person will not act as an agent for more than one insurer. One life insurer, one general insurer, one health insurer, whatever. Okay, and this I have already told you that no policy of life insurance is going to be called in question on any ground after 3 years, right? On any ground of misstatement after 3 years, within 3 years it can be called, right? Okay. Moreover, the insurance agent or the intermediary cannot become the director of the insurance company. Then one more thing, dividing business is not allowed. That means you cannot say that if I collect a lot of premium, then you will get this much benefit. if I have to pay so much of claims, then you will not get this much benefit. Just like how it operates in case of mutual fund. If the market is high, then you'll get high returns. No, this is not going to happen. Undoubtedly, there can be a component of bonus which may be provided, but then it is not going to be strictly based on dividing business, right? We have two councils, Life Insurance Council and General Insurance Council. Then we have surveyors or loss assessors who must possess the required qualification, and they must be the member of Indian Institute of Insurance Surveyors and Loss Assessors. Okay. All the assets and liabilities are going to be valued for not more than market value, and every insurer or reinsurer at all times have to maintain assets over the amount of liabilities. That means your assets will always be more than liabilities at least 50% of the minimum capital. If this is not complied, then you are deemed as insolvent, right? Moving to the next part, that is IRDA, Insurance Regulatory and Development Authority. Right, so we have this authority to safeguard policyholders, and this is not just regulation, this is also development. So this also upgrades, or this also develops the whole insurance sector. Central government establishes an authority which is going to be body corporate, and the head office will be determined by central government. It will have a chairman, maximum five whole-time members and maximum 4 part-time members. Maximum age of chairman 65 years, others 62 years. They will be appointed for 5 years at once. They can be reappointed. If any member or chairperson want to resign by giving 3 months notice to central government, they can resign. They can also be removed from their office if they become insolvent or insane, or convicted for offense involving moral turpitude, or they act against public interest or require some financial interest which is not legal. Okay. Now, when they leave this authority, they have a bar on employment for 2 years. So for 2 years, they cannot be employed or appointed in central government, state government, or insurance sector. The authority is going to meet and take decisions by voting. The votes shall happen, and in case there is a tie, chairperson will have a casting vote. So chairperson is the person who's actually responsible for the whole general superintendent and everything. Then we have a section number 14, which prescribes wide powers of the authority. So authority, first thing, whenever you want to open an insurance company, you have to register with IRDA. So that registration certificate is being granted, it is being suspended, it is being cancelled, all done by IRDA, right? Then you also specify the code for your surveyors, code of conduct, how you have to behave. Then specifying the qualifications for the agents, intermediaries, conducting a lot of investigations, regulating the tariff advisory committee. What is tariff advisory committee? The committee which is being formed to prescribe and make norms for your minimum, maximum tariff and all that, the premiums that are being collected by the insurance companies, so that undue advantage is not taken by the companies and the policy holders do not suffer. So uniform, to maintain that uniformity in the tariff or the premiums, right? So that is being supervised, and other regulating investment funds, a fund which is being maintained, settling disputes. So all this is being done by the authority. For this, the authority also has a fund, IRDA of India Fund. So central government grants necessary funds for running this authority. So it gets money from central government and other sources, and it uses the money for payment of salary of the members and other legitimate expenses of the authority. It has to maintain all the books of accounts and annual financial statements which are going to be audited by CAG and also presented before Parliament and central government, right? Apart from that, central government has the power to issue directions to the authority. If the authority is not performing well, if there is some fraud or they're constantly defaulting in the directions, then they can also be superseded by the government. So central government, maximum tenure of supersession, 6 months. So within 6 months, they can bring in new people and reform the authority. You also have to furnish a lot of returns or information to central government. All the members, chairperson, everyone is going to be the public servant, and insurance advisory committee will also be formed, which is going to advise IRDA on certain matters and also on making regulations. So that are some general part apart from this sections that we have read, right? Okay. Let's now revise some legal provisions relating to MSME sector. What is MSME? Micro, small, medium enterprise. Right. Now, it is no such special type of enterprise or any special type of business form of organization. Any enterprise means which is engaged in the manufacturing sector or the service sector, which meets the criteria as given under this act, will be called as MSME. Now, MSME is a highly dynamic sector, and government undoubtedly wants to promote it as it generates a lot of employment, it results in equitable distribution and a lot of benefits, right? So we have a dedicated ministry, the Ministry of Micro, Small and Medium Enterprises for the same. Although the primary responsibility for development of MSMEs lies with the state government, central government undoubtedly facilitates a lot through the ministry that we have. Now, coming to the act, we have MSME Development Act 2006. The first thing that we read is about the definition of MSME, what will be called as micro enterprise, what will be called as small enterprise, and what will be called as medium enterprise. So we divide the definition into two categories, manufacturing sector and service sector. However, for both the categories, we have a composite criteria, which is the same given, so there is no change. What is the criteria, ma'am? We check two things: investment in plant and machinery and turnover. They should both be below a certain threshold to come into this type of category. So if investment in plant and machinery is less than equal to 1 CR and turnover less than equal to 5 CR, micro enterprise. Investment in plant and machinery less than equal to 10 CR and turnover less than equal to 50 CR, small enterprise. Investment in plant and machinery less than equal to 50 CR and turnover less than equal to 250 CR, medium enterprise. Now, when we read this definition, we have to take care of certain things, that investment in plant and machinery will be according to ITR, and it will include all the tangible asset but will not include the land and furniture and fixtures. If we talk about turnover, again, IT returns, GST returns, the data will be compiled from there. And moreover, the value of exports shall be excluded. Okay. Then we come to certain other important definitions, of which we have just one very important definition, which is appointed day. Appointed day has a relevance when we study about the delayed payments to MSMEs. So it has more relevance over there, but we'll read the definition. We'll revise the definition first. If MSME has supplied some goods and you are supposed to make payment, this act ensures that you make timely payment. What is going to be timely payment? That all we'll discuss later, right? Here we are concerned about that when goods are delivered, it is the day of acceptance. Okay. And when the day of acceptance is there, after that expiry of 15 days, following day is going to be the appointed day. But sometimes it may so happen that the goods have been delivered, but there is a dispute. That means the goods have not been accepted yet. So till the time the goods have not been accepted, the date of removal of objection will be considered as the date of acceptance, and thereafter we will compute the appointed day accordingly. Now, Section 3. Central government establishes a national board for MSME. They examine factors affecting the development of MSMEs, review policies that CG has made, give recommendations, and also advise CG on the use of fund that CG has constituted under this act. So CG constitutes a fund known as MSME fund, wherein CG gives all the grants, and that has to be utilized only for MSME sector. CG itself is responsible for that fund, and CG ensures the monitoring and everything of the fund. Okay, so advisation matters will be there from national board, and also we have an advisory committee which is again constituted by CG, and it advises CG on certain matters, and it also advises this national board on certain matters. Okay, so we have different authorities and different bodies which have been constituted under this act. We have another thing that we have to read for national board, which is composition of board, which I have not reproduced over here, nor I'm discussing in this revision class. Why? Because it is huge. So composition you have to learn. They all are going to meet once in 3 months in every year. Apart from that, we have a section 9 also, which just gives power to central government to formulate guidelines, notification policies with respect to different issues. Like, we want the MSMEs to be more competitive, we want to develop their skill, we want to upgrade their technology, some management issues, providing them infrastructure facility, cluster development, credit facility. So using that powers, CG has in fact formulated a lot of schemes for the development of MSME units. So this is huge list of MSME schemes that we have. Anyway, moving to the next part is our registration. Under section 8, see, registration of MSMEs is not mandatory, but if you want to avail the benefits under the act, then you must get yourself registered. How to get yourself registered? Simply by filing a memorandum with the specified authority as given by state government. So where do we file memorandum, and what is memorandum? Memorandum is nothing but like an application form only. It's called as memorandum because you're furnishing information, and that's it. It's a free of cost process. There are 2 ways to do it. Udyam registration portal, you can file Udyog Aadhaar memorandum, or NSIC. NSIC, what is NSIC? That we'll discuss later. But they have designed a single window system. They also have the power, and using that, they work for promotion and betterment of MSMEs. So they have designed a single window system for MSMEs, and their champions control room at DIC. So you can do that by filing form over there as well. Then we have one of the important things in this chapter, that is delayed payment monitoring or delayed payments to MSMEs. See, payment to supplier has to be made. If MSME has provided any goods, the act ensures that you make timely payment to these MSMEs. If there exists an agreement between buyer and supplier, then you have to make payment before the date specified in the agreement, and this date cannot be beyond 45 days. Supposedly you do not have any agreement with respect to payment, then you have to make payment before appointed day that we discussed. That means after the goods have been accepted, you have 15 days time to make payment. Fine. If it is not paid, then the buyer will be liable to pay compound interest at monthly rest from appointed day or the day agreed at 3 times of bank rate specified by RBI. That's not complete. The interest will not be allowed as deduction to the buyer, and moreover, he has to also report the same in his annual accounts. The amount that he has not paid, principal amount, interest, separately in his annual accounts. So he has to incorporate that also. Okay, fine, ma'am. Now, we have another point with respect to this, which is counsel. Supposedly, there is delay in payment. Supposedly, there is dispute in payment. Where can the parties go? Is there a separate forum which is there in this act? The answer is yes. We have a separate forum called as Micro and Small Enterprises Facilitation Council, MSEFC, which is established by state government. So undoubtedly we'll have different councils. Minimum 3 members, maximum 5 members. These members will be selected from Director of Industries. representative of Association of MSA, representative of banks or financial institutions, persons with special knowledge. What is this council going to do? They are going to deal with the disputes. So any party can refer to the council. And when council receives such reference, the first attempt the council makes is conciliation. That means the council tries to resolve the differences between both the parties and bring them to settle by acting as a conciliator themselves or referring it to someone else. If conciliation cannot take place, that means if settlement cannot take place, then it acts as an arbitrator and it decides who is correct, who is incorrect, and gives a judgment, gives a verdict, gives an arbitral award. Okay. Any reference made to the council is going to be decided within 90 days. Which reference can be made to the council? See, if the supplier falls in the jurisdiction of that council, the council can act as arbitrator or conciliator. It doesn't matter where the buyer is from. The buyer can be anywhere in India. The supplier has to be in his jurisdiction. Now, all these things happen through an online platform, which is MSME Samadhan, online portal for delayed payment monitoring system. Just like we have MCA portal, likewise, we also have this portal. Fine, we want to reach to this particular council, but we will file it online and it will be reached to that particular council. That council will take action, and all the government ministry, everyone is involved, so everyone can monitor what things are happening and how things are happening. Okay, fine, ma'am. Now, I think I told you about NSIC, National Small Industries Corporation Limited. It was established in 1955. It works through different offices, and the main purpose is just to provide support services to MSMEs. Right. Now, we come to the various schemes or benefits. See, first thing, government has formulated a lot of schemes for the betterment of MSEs, but they do not have adequate knowledge and hence they are unable to get the benefits. What are the benefits, ma'am? Security support, financial support, technical support, improving their livelihood. Why? Because they are providing you infrastructure, credit facilities, modern testing, flow of credit, modern management, entrepreneurship development, the same things that we discussed in section 9, skill upgradation, right? A lot of support. So all that support they are providing, and it's benefiting MSMEs in a lot of ways, but MSMEs are not aware and hence they are mostly unable to utilize or benefit themselves from these schemes. However, out of all the schemes or benefits, we are reading a few. First one, revival and rehabilitation. Whenever MSME are being given some loan, they might not be in a position to repay it back, and that's why restructuring may be needed. So this scheme provides about restructuring of the same. Procurement preference policy, government ensures just to in order to encourage them that they should continue their production, government ensures that okay, fine, this much or supposedly maybe these many items we are going to procure from MSMEs only. So it does not matter whether the big shot players are producing that, government will take that product from MSME only. Right. Likewise, you have reservation policies by government, that government reserves a certain thing, that this is going to happen from MSME only. We are going to encourage women entrepreneurs also. Okay. So a lot of reservation policies, a lot of preference, procurement preference policy, all that happens by government for the betterment of MSMEs. Okay. Digital MSME. What is digital MSME? The government wants MSME to digitalize, right? That means by using ERP, by using accounting softwares, by using all those things. So in that, government helps these MSMEs by creating more awareness, by providing them training with respect to ERP, by providing them, telling them their benefits. Then we have ECLGS, which basically relates to COVID-19, and it is emergency credit linked guarantee scheme. It tells that banks or NBFC, you provide credit to MSMEs, will give you 100% guarantee cover, but capping of 4 years and rate of interest maximum 9.25 for banks and 14% for NBFC. Then we have SBL, secured business loan by SEBI, 10 crores maximum for 10 years. PMEGP, Employment Generation Program. So, credit subsidy will be given by government for generating employment. Reservation policies, I already told you. Special consideration in international trade fairs and all. And training will also be provided through the training programs that we have. After that, we have some recent announcement, of which one scheme is important, and that I have designed a chart for the same. Credit guarantee scheme for subordinate debt. We have MSME who has already taken loan and they are unable to repay that loan. That means they are recognized as NPAs or stressed assets by these banking institutions or the lending institutions. Now, government is saying to give them more credit to promoters of MSME unit equal to 15% of his stake, subject to maximum of 75 lakh, and guarantee coverage will be provided by the government. It will be treated as separate loan, and for the same 20,000 crores have been allocated. So provision has been made for. Okay, fine. Okay, let's now revise the chapter of cyber security, that is the laws and regulations relating to cyber security. We all know that the chapter is ideally being divided into three parts. First, we have some content of IT Act that we have to study. The second portion is all about business intelligence, and the third portion is cyber crimes, which is again related to IT Act but has been given as a separate topic over here. Right now, although we have a lot of framework and background to understand about IT Act and also to understand about business intelligence, but since we are just revising this particular chapter, I'll not get into those intricate basics and details. We will straight away come to what is the core content and is required from examination perspective. So if we talk about IT Act, Information Technology Act, we know that it is an act of parliament. It was notified on 17th October 2000 and it's applicable to whole of India. In fact, its applicability extends beyond as well. Now, why this particular act came into picture? We know about electronic transactions, we know about electronic records, we also know about digital signatures, right? Earlier, we did not have electronic records, we did not have electronic transactions, and digital signatures, forget it. We just had physical signatures, and they were only considered to be authentic and if there is a paper on which you have my sign, then that is authentic and that can be treated as evidence, that can be treated as my command, right? But now, after inception of this particular act, because we know that the times are changing and we have onset of technology, so a lot of things are being digitalized, so the signatures also need to be digitalized, right? But obviously this should not be misused by people, and to prevent misuse a lot of laws are required. So first thing, this act gives legal recognition to the electronic transactions and digital signatures. It also facilitates the e-filing of documents, especially when we're talking with the government departments. It further amends other acts like what, ma'am? Like IPC, like Indian Evidence Act. And we have a certifying authority under the act, mainly that relates to digital signatures. So licensing, monitoring, all of that is also covered over here. Fortunately, unfortunately, we don't have to read the entire act. We just have to read a few sections of the act. So we will only compile those relevant sections. Before we actually go on, some part of the cyber crime I'm discussing here itself, because here we have incorporated in our charts. Now, what is cyber crime? To be precise, we have crimes in our physical space also, like someone may intrude into our house. That is a cyber crime. Trespassing, that is a crime, right? Trespassing. Someone has come to my physical place. That means someone has intruded into my physical space. Now, if someone or any criminal activity takes place in the cyberspace, cyberspace means by using computer, by using the technology, by using the network, right? If they are intruding into the cyberspace that we have, then that is a criminal activity taking place in cyberspace, that is cybercrime. Now, these crimes are recognized because if someone is hurting my emotions physically, then that's a crime. If someone is kidnapping me physically, that's a crime. If someone is following me physically, passing certain comments physically, then that is all a crime. Then the same thing, if happening in the cyberspace, should also be considered as a crime. If someone is stealing anything that belongs to my house, maybe that's some precious jewelry, maybe that's some cash or whatever I've kept at my place, if stealing that is a crime, then what I have stored in my computer, that is my data, and if someone is trying to steal that data, then that should also be a crime. Just because it's happening in some cyberspace, we cannot say that, oh, no, it's not a crime. Of course, it is a crime. So we have to recognize such type of cyber crimes, and these crimes are recognized not just under IT Act, but also under IPC. So under IT Act, we have tampering, Section 65, hacking, Section 66, obscenity, Section 67, unauthorized access, Section 70, breach of confidentiality, Section 72, false TSC, Section 73. Ma'am, do we need to learn the section numbers over here? The answer is yes. Although we have classified cyber crimes against into three categories: against person, against government, and of course against property, right? But we'll read that later. These section numbers from examination perspective are to be learned. Okay. Now, under IPC, if someone tries to threaten you by sending an email, Section 503, defamatory message by email, Section 499, forgery, Section 463, bogus website fraud, Section 420, email spoofing, Section 463, web jacking, 383, email abuse, 500. We have discussed about the terms. Okay. Now, back to the IT Act, back to the core IT Act that we have to study. Electronic records. If I have to deliver a document to you, when I'm dispatching, you know it. When I'm giving it to you, you know it. You know exactly the moment when it's taking place because it's happening in the physical space. But when the electronic document is moving into some cyberspace and reaching a person, what is the time and place? Because it's all happening in the cyberspace, right? So just for that clarification, although we know it, but this section is kind of a clarificatory section. So we have an originator and we have an addressee. I am the originator. If I'm sending the document to you, you are the addressee if you're receiving the document, right? We all have our computer resource. Computer resource means my computer or my network that is within my control. And we have a computer resource or network outside my control. And then there will be your computer resource, right? So what will be the time of dispatch when it enters a computer resource outside my control? That means it hasn't reached you yet, but it has gone out of my control. So it is somewhere in the network which is not in my control. So that will be considered as the time of dispatch. What will be the time of receipt when it enters your computer resource? That means when it enters the designated computer resource. When it enters the designated computer resource. What will be the place of business, place of dispatch, and place of receipt? Right? Because time and place become important when we want to enforce certain type of contracts. Okay. Now, under this act, we have certifying authorities. What are certifying authorities? See, central governments appoint CCA and CCA gives license to CA. CA means certifying authority. Certifying authority issues DSC to person like us. So we have 4 people involved: central government, CCA, CA, and then people like us, right? So CCA, that is Controller of Certifying Authority, they recognize certifying authority, they regulate them, give them license to issue DSC and also supervise them. Adjudication. Central government appoints an officer who is going to be considered as an adjudicating officer. See, if we do anything which, if we're trying to contravene any of the provisions, then he is going to hold inquiry. And after considering the factors, he decides about our contravention, that whether we have contravened a certain provision or not. If you're dissatisfied with his order, we can appeal within 45 days to another authority, that is Cyber Appellate Tribunal. If we're still aggrieved, we can further make an appeal to High Court within 60 days. A lot of times data is being collected by government, by other organizations also. What type of data? Our personal sensitive data. What is our personal sensitive data? You go out to get an Aadhaar made, you have to give your biometrics. Isn't it personal sensitive data? Can't it be misused? Banks have your credit card, debit card information, right? Some have your health conditions information. So there could be ample of personal sensitive data which is only available to you and which you do not share in the public domain. Any document or any data which is available in the public domain is not your personal data. So which you keep it to yourself, but you have to disclose it to government, because government has made certain things and you have to tell, or you have to give it to certain organizations. Now, you have fulfilled your duty as a citizen to do so, but it's government's duty. It's the organizations who collect your personal duty. It's their duty to protect your data. Data protection hence refers to the set of policies which are being implemented to protect sensitive data. And it can be collected only if it is lawful, if it is for lawful purpose. We people are aware that it's being collected. We are given an opportunity to review what data is being collected. You ensure its security, and you also designate a grievance officer, that if we have any issue, we can contact that person and he will be resolving our problems. Okay, so we have to maintain confidentiality. We don't have to disclose it to any third party. If we do it, penalty under section 72A. If we don't secure the data, that means if security is compromised, then damages under section 43A. Okay, fine. Moving to the next part, business intelligence. Business intelligence. What is business intelligence? See, we have a lot of raw data which cannot be used for decision making. That means maybe an organization has made 1 lakh sales. What decision you'll make by just getting that data? No. But if we classify the data, if we analyze the data in such manner that we get useful information out of this, then that is going to be helpful. Now, business intelligence is a technology-driven process. It's not the manual process, but is a technology-driven process which actually analyzes your data and converts your raw data into useful information which you can use to make data-driven decisions. Right? Like if from that 1 lakh sales data, we get to know that, okay, fine, 70% of women consumers are interested in our product. So we get to know, okay, fine, our product is being liked by women consumers. So maybe we should target more over there. So marketing department can make a move. They can make an informed decision based on data. Otherwise, they would be just going around by some gut feeling or experience, right? Undoubtedly, people take a lot of decisions, but then if the decision is data driven, it helps a lot. It improves your efficiency, it increases revenue, and it also helps to gain competitive advantage over the rivals. Now, how this business intelligence process works? It is a technology driven process, so undoubtedly it has to collect all the data first. Where will the data be available? Maybe one data warehouse for the entire organization, or maybe department wise we have different data, like financial data can be obtained from ERP softwares. So all the data has to be compiled, integrated, and then proper sets have to be prepared. So data preparation is ideally the first step. I can say these are the 4 steps. that we have to focus on: data preparation in sets, then analytical querying on that data, distribution of KPIs, key performance indicators, and then use of information. We have to distribute KPIs in such a manner that we can actually decide that, okay, fine, when we're talking about maybe average response time to a customer, we are able to compare our actual data to our standard ones, right? So accordingly, the KPIs have to be distributed, and then use of information to take that decision. So these are the 4 steps involved in the process, how business intelligence works. We have ample of BI softwares or BI platforms which are available. Ad hoc analysis, that is the first one, which deals with the issues on temporary basis. Then we have OLAP. OLAP is for more complex queries, online analytical processing, which actually uses multi-dimensional database. From here, from here, from here, you're picking up information and you're able to combine, drill down, and do a lot of things, right? We've discussed everything in detail. It's just, I am only pinpointing something that you need for your examination perspective. Mobile BI, something that's available in your smartphones, tablets. Then we have real-time BI, which gives you up-to-date view, not something which is historical. Operational intelligence only relates to your operations. Then you have open source BI. Open source BI, in which you have 2 refined versions. One is free, one is paid. Embedded BI, the most important one. It actually incorporates the features of business intelligence in your homegrown business application. So you have an app, in that only they'll provide you these features. Collaborative BI, which you can share with others, right? Location intelligence, it all talks about the location and geospatial data, right? So we have different types of softwares, and on that only, the modern BI platforms are the tools that we have: data visualization, tools for building dashboards, storytelling features, usage monitoring, right? I have shown you that picture also. I gave you an example of what Qlik, right, and Tableau, right? So we have a lot of tools which are available. See, some tools are absolutely free. As I told you before also, if we wanted to edit a photograph back in the old times, it was not possible for a normal person to do so. Only the experts could do so. But now we can also do so. Why? Because we have photo editing softwares which are free and user friendly. We're just putting the softwares, adding filters to our photos, right? So we can do that. Likewise, this was possible only by the IT analyst back then. But now, thanks to these BI platforms and tools which are available, and in which we do not require any coding, anything like that, we just feed the information and it analyzes the data and brings us useful information so we can use it, right? Next is cyber crime. Cybercrime, although I have already explained you what cybercrime is all about, if we talk one by one, cybercrime against person, the first one, cyber stalking. So if you are trying to create some physical threat by stalking people in the cyberspace, like going to their maybe mail, phone, text, webcam, whatever it be, that's cyber stalking. Obscenity, indecent exposure to something which should not happen. It includes child pornography. Defamation, trying to lower the dignity of someone. Cracking is exactly hacking also, I would say. Or let me first discuss hacking only, because hacking is getting that unauthorized control or access, and cracking is someone is breaking into your computer and is tampering with your confidential information. Spoofing, distancing the origin, like pretending that it is being sent by someone else. Email spoofing is what? A spoofed email is what? It misrepresents the origin. That means you do not know, you think that this person has sent it, but it's using a different path or a different thing. Carding is all about the frauds related to ATM card, credit card. Fraud is a generic term, and threat. Threat is maybe giving threatening messages via mail or anything like that. That is all threatening. If I talk about against property, we have broadly 5 things. Squatting, fighting over a same common domain name, maybe. Then vandalism is trying to intentionally destroy the property of other. What could be the property? Here we are talking about the computer, we are talking about the computer resources, we are talking about the data which is in there. Hacking, now hacking is against a person also, because you get into someone's private space, but then after getting into someone's private space, if you're destroying that, that is a crime against property also. Virus, again, virus does the same thing, gets into your system and destroys everything. Trespass, unauthorized entry. Then we have against government, which is considered to be the most important from examination perspective. Cyber terrorism, very, very, very important issue. There could be hate websites, there could be hate mails which are being circulated, and it should be prevented. Warfare is again related to hacking, but hacking and then spying with a political motive, that means you're trying to steal that confidential information, or you're just trying to spy, just like CCTV does, right? So hacking and getting into someone's cyberspace and then spying. Piracy, duplicacy, right? And duplicacy of government records, maybe you have a government license, issuing license, or maybe counterfeit currency notes, etc., etc. Unauthorized information, it could be political, it could be religious, it could be any information that government does not want to disclose to public, but you are getting access to that by getting into someone's cyberspace, right? So that is different types of cyber crime. Now the revision of PMLA. Now the very first section that we have to read in PMLA is ideally section number 3, which talks about the offense of money laundering, who is deemed to have committed an offense under money laundering. So for that, we first need to understand what do we mean by a scheduled offense. Scheduled offense ideally is the offense which is specified in Schedule 1 of the Act, which is divided into 3 parts: Part A, Part B, and Part C. Part A, all offenses. Part B, offenses of value 1 crore or more. And Part C, all offenses. So these are the offenses which are specified in Schedule 1, which are considered to be scheduled offense. If you do any of this offense and you derive something out of that offense, it could be your intangible asset, it could be your tangible asset, movable, any money, anything, that is known as proceeds of crime. Now that proceeds of crime, if you hold it, if you try to conceal it, if you try to possess it, if you try to use it, that is involvement in any activity relating to proceeds of crime. And if you involve in any activity relating to proceeds of crime and you're trying to project it or use it as an untainted property, then that is offense of money laundering. Even if you attempt to do so, then also it is an offense. If you indulge, then of course it is. If you assist someone, it is. If you are a party to that, it is an offense. Whether directly or indirectly, you are directly doing it or you're getting it done through someone. In both the cases, it will be an offense of money laundering. Now, the process of money laundering, ideally you can say money laundering is an act through which black money is converted into white money. Of course, black money can be obtained through different sources, like by evasion of taxes or by indulging yourself into some illegal activities. The money obtained from only those offenses which are specified in scheduled offense and conversion of it is money laundering. So if I am a criminal and I'm trying to wash off my money, that is actually money laundering. There are various methods through which you can do money laundering, like you can do smuggling of cash, structuring, then entering into real estate transactions, stock market scams, bogus companies. Of course, here we are not trying to teach you how to do money laundering. This act is all about prevention of money laundering. So the act hereby intends to prevent money laundering. That is how people should not at all enter into this process of money laundering. That is the main focus. The two authorities under the act are Directorate of Enforcement and FIU, that is Financial Intelligence Unit of India. Okay. Now, there are 3 stages of money laundering: placement, luring, integration. Placement is when you place the proceeds of crime into the system. Luring is to make it far away from the source. and by entering into a series of transactions from here to here, here to here, here to here, and integration is finally returning the money as if it was a legitimate source. Whenever anyone enters into this process of money laundering or attempts to do this money laundering, he is deemed to have committed an offense under money laundering. And when he does an offense of money laundering, he is liable for punishment. The punishment is given in section number 4. Now, before we go on to section number 4, we remember that schedule 1 is divided into 3 parts. Part A, paragraph 2, the most important one, is relating to the offenses under Narcotics, Drugs and Psychotropic Substances Act, which is very important for you to learn, because if you indulge into the proceeds of crime of that particular act, then you have a little serious punishment. The punishment of offense of money laundering involves rigorous imprisonment and fine. Rigorous imprisonment, minimum 3 years, but the maximum differs in both cases. If it is an offense of drugs, then maximum imprisonment 10 years. But if it is other than that, maximum imprisonment only 7 years. Okay, so that is the only difference in both these type of punishments, which you must remember and must learn. Okay. Now we have different definitions, and first let's talk about the reporting entities. Who are the reporting entities? That is the first question. Reporting entities: banking companies, financial institutions, intermediaries, and even, I would say, the persons who are designating certain types of business or profession, who can be the persons who are dealers in precious metals, real estate agents, registrar, and casino, and all that. These are the places through which money laundering actually takes place. Because if I want to convert my black money into white money, how do I convert this? How do I enter into this financial system? The choices that I have are these reporting entities only. Right, that is the banking company, financial institution, intermediary, and the person who are carrying on designated business or profession. So through them only I can inject money into the system. So obviously they will be exposed to the proceeds of crime. They have to be cautious, they have to maintain proper records, and they have to do proper reporting. So government has imposed an obligation on them only, that you take care of all these things. What you have to do is you have to maintain your record about the identity of your client. And when the client ends the relationship with you, that means I have closed the account. Despite that fact, you will still maintain my record for next 5 years. So after closure also, you have to maintain account for 5 years. You have to maintain the transactions record, the transactions as may be prescribed. So whatever high value transactions have been prescribed, you have to maintain a separate record for that also. And when the transaction takes place after 5 years, you have to keep on maintaining that record. After that, you can discard. And the same thing has to be reported also in such manner and time as prescribed. Reported to whom? Reported to the Director of Financial Intelligence Unit of India. Okay, so it has to be reported to that. Whatever information you're obtaining from the client, that has to be maintained as confidential. Apart from that, we have some more sections. We have section number 11A. What is 11A? Verification of identity by the reporting entity. Supposedly, I am a bank. If anyone comes to me to open a bank account, what I have to do? I have to verify his identity. How can I do that? I can do Aadhaar online authentication, Aadhaar offline verification, then passport verification, or any other document proof, right? So banks take that. Aadhaar is not compulsory. You have a choice. You can provide any of this document to verify your identity. It is your choice. The banks cannot compel you that you have to give Aadhaar only. Even if you don't have Aadhaar, very well the relationship can be established. Earlier, government had authorized only the banks to do this online Aadhaar verification. Like if you go to a bank, I hope you know that online Aadhaar authentication can also be done. Now this has been also allowed for NPCI. Okay, so National Payments Corporation of India are also permitted to do so. Then we also have a section called as 12AA. 12AA is about enhanced due diligence. That means some more cautious of the specified transactions. If a person comes and wants to deposit or withdraw a huge chunk of cash, why? If you want to enter into any foreign exchange transaction exceeding a specific amount, why? High value imports, why? Or any transaction which involves high risk, why? So, in such cases, you must verify the identity of clients, verify their ownership, verify the financial position, verify to whom it is going, right? And if the client fails to give you information about the same specified transaction will not take place, and you have to maintain this information, maintain this record again for a period of 5 years. So we have three sections wherein reporting entity has to verify something and maintain records: section 11A, section 12, and section 12AA. These records have to be maintained. These records can be called by the Director of Enforcement anytime, and it is the duty of reporting entity that you must furnish information within the prescribed time and manner. Apart from this, some additional information, also like cash transaction reports, suspicious transaction reports, can also be asked. Whatever information the director obtains through this course has also be required to be maintained as confidential by the director himself. Now, the director has the power to impose fine. Before I tell you this section, I must recall the hierarchy. Director of Rate of Enforcement, Adjudicating Authority, Appellate Tribunal, Special Court, and then High Court. That is how the hierarchy moves when we are talking about this particular act, right? So Directorate of Enforcement has director, it has additional director, joint director, deputy director, assistant director, other officers. So these are the hierarchy which they have. Now, supposedly the director himself thought so, or it gets an application by some authority, officer, or person that this reporting entity is not fulfilling its obligation. Reporting entity is bank. Bank is not doing what it has to. So director, after inquiry, can pass certain orders. But during inquiry, it sometimes happens that the accounts are all complex. You are unable to identify what is going, what is happening. So in such a case, the director can direct the reporting entity that this is a panel of chartered accountants maintained, select one and get the audit done. Right? We will bear the cost. So the audit will be done and the report will be in our hand. Now we can come to a conclusion that whether they have complied with the obligations or non-compliance is there. If non-compliance is there, then we can issue further orders. And if the case is not so complex, the director himself may carry out the inquiry and come to a conclusion that yes, there is a failure to comply with the obligations. In such a case, there can be four directions, four orders which may be passed: issuing of written warning, then giving a direction to comply with specific requirement, giving a direction to do some more reporting, sending submission of some more reports, and imposing some monetary penalties. Okay, whatever order is passed, the copy will be forwarded to the parties. Now, authorities under the Act, we have adjudicating authority, which is constituted under Section 6. We have appellate tribunal, which is constituted under Section 25 of the Act. And what do? They carry out the proceedings with respect to attachment and confiscation of property. In fact, appellate tribunal is designed to hear the appeals against the order of adjudicating authority as well as the director. Right? Then we have financial intelligence unit. This comes under Department of Revenue, Ministry of Finance, and is basically responsible for collection of suspected financial transactions. So it collects, it analyzes, it disseminates all that information. Right. Then we have Enforcement Directorate, one of the most important authorities under the Act, which again comes under Department of Revenue, Ministry of Finance. And this particular agency, its main task is to enforce PMLA and FEMA, and to investigate offense under PMLA. So it has the powers to investigate also under PMLA. In fact, we have section 5, which talks about attachment, as seen before. That also, who has the power to do that? It is anyone not below the rank of deputy director to do so. Now, special courts, central government in consultation with Chief Justice of High Court, they designate some session courts in different states and different duties as the special courts. Now, these special courts will try the offense of PMLA, plus they also try the offense, or you can say try the scheduled offense, which is underlying the offense of money laundering, right? Okay, then we have the procedure of investigation. In procedure of investigation, undoubtedly there are parties who are involved or authorities which are involved. The first authority, adjudicating authority. The second authority, enforcement directorate, which has been conferred the powers of investigation and attachment, confiscation. Thereby, adjudicating authority confirms the attachment or confiscation. Then we also have appellate tribunal, wherein you can prefer for appeals. Then you have special courts where the offense of money laundering is being tried along with the scheduled offense. And then you also have reciprocal arrangements, which we talk about, that is the bilateral agreements which exchange information and aids in the process of investigation. Thereafter, appellate tribunal, this is something that we've already discussed. You can appeal to appellate tribunal within 45 days, and appellate tribunal's endeavor is to dispose of the matter within 2 years. If you're still not satisfied, you may go ahead and appeal to High Court. Now we have something called as reporting, and it is connected to section number 12. So section number 12 imposes an obligation on reporting entities to report certain matters. In the same league, we have prevention of money laundering, maintenance of record rules 2005, which imposes an obligation that you need to maintain records. Maintain what records? Maintain records which involve the cash transaction of more than 10 lakhs, some integrated transactions which are less than 10 lakh, but in aggregate they exceed 10 lakh per month, all the receipts of 10 lakh or more by NPO, any transaction which involves counterfeit currency, other suspicious transactions, including the transactions of immovable property valued of 50 lakh or more. How do they have to maintain this? They have to maintain this in a prescribed format, along with the obligation to identify your clients and ensure their authenticity. They have to, every entity must have a principal officer which is going to make this report to director of FIU. Along with this, there is also a concept of suspicious transaction reports. Now, what is a suspicious transaction? It may involve cash, it may not involve cash. However, if it creates a suspicion that maybe this involves proceeds of crime, or it appears unusually complex, or it does not appear to have any bona fide purpose, then such type of transaction is considered as a suspicious transaction, and thereafter report has to be made and accordingly furnished to the director of FIU. We also have a KYC, centralized KYC registry, which has been incorporated in the year 2015, and this is a kind of central repository which has been created. So entities have to, within 10 days, file electronic data with the KYC registry, and this is going to include the data, keep the data, analyze and transform the data, right? Okay. Now, corporate governance. See, corporate governance, basically what it means, it is all about managing the business, right? That means adopting such process or procedures to manage the affairs of the company which comply on 3 parameters. fairness, honesty, transparency, actually fairness, accountability, and transparency. But we can say that corporate governance is a procedure by which affairs of a corporate are being managed with regards to fairness, honesty, and good practices. Of course, it is not going to benefit only the company, but it is ultimately going to benefit all the stakeholders. So, corporate governance, if you adopt these processes in managing the affairs of the company, it is going to be beneficial for all the stakeholders were around. Right. Now, what is this corporate governance? Okay, fine. There are certain procedures or there are certain processes that we have to adapt. Is this procedure complied or written in law? The answer is yes. A lot of corporate governance procedures have been imbibed in law to make it mandatory for the benefit of all stakeholders. However, there are there is still a lot of scope of fair practices, honest practices, good practices for the benefit of all stakeholders, which might not be made mandatory in law, but which are the thought processes of upper management, and it flows down throughout the company, which is called as the top-down approach. Okay, so it is about managing a company with regards to fairness, honesty, and good practices. Who manages any company? A company is being managed by the board of directors or the shareholders, right? Ultimately, it is being managed undoubtedly by the board of directors only, but shareholders also have certain decision making powers. So, mainly, they are responsible for the governance of companies. The governance can be good or bad. Of course, good governance, when we talk about it, brings good image, reputation, it helps in good finance, trust in the company, and ultimate growth of the company. So, corporate governance normally applies at the top level, as I explained to you, and it flows from top to bottom, which is also called as top-down approach. Now, see, corporate governance is the main motive, or you can say, when we talk about the objectives of corporate governance, it is all about bringing transparency, bringing more justified policies for all the stakeholders. Right. Corporate governance aims at bringing an ideal composition of board of directors, because they are the ones who are ultimately responsible for governance of companies. So if there is an ultimate ideal composition of board of directors, ultimately there will be fair practices in the company. Right. If there is corporate governance, then there will be optimum use of resources. Resources means all the type of resources. There will be reduction in risk management. Okay. And undoubtedly, you are going to develop a strong relationship with your customers, with your suppliers, with the government, with your employees, with everyone. So there will be a strong relationship of the company as well as all the stakeholders. So it brings about transparency, it brings about good management, it enhances the value of enterprise, it makes people accountable, it helps in more innovation, it helps in bringing professionalism in the corporates, and it also incorporates, or all the stakeholders are also contribute towards the company, right? Now, ma'am, is it similar to what we call as ethics? No, ethics are an individual choice, right? And everyone has an individual choice. So a manager also has an individual choice, and so is a peon who is working. However, when we talk about corporate governance, we have to adopt the policies which are being developed by the corporate. So it normally applies at the top level and it flows from there, right? Ethics emerge naturally, but corporate governance is studied, experienced, evaluated policies which you develop over the period of time for ensuring fair practices in the company, right? So in ethics, there are no regulations. However, in corporate governance, there are regulations which are involved, right? In the same manner, it distinguishes management also from corporate governance. Management is different. Management also applies at all levels. However, corporate governance applies only at the top level. Right. Regulations are not important in management, but in corporate governance, regulations are very important. Okay. Corporate governance is not about achieving any result. However, managers are focused. This is our target. This is our target. This is what we have to achieve. So, managers are all about achieving a particular target. However, corporate governance is the process. You have to achieve the target, that's a different thing. But corporate governance is about fair method of reaching, fair method of that procedure, fair method of managing a company towards your target, right? So methodology of achieving results is more important than the actual result in corporate governance. Right. Now, corporate governance has been evolved because of the corporate failures that we have witnessed, because of more investors being participating in the market, and especially institutional as well as retail investor. A lot of retail investors have also increased. So the government also want that only secured information is being passed, and that information is should be reliable. So increasing transparency, increasing disclosure, that has led to more evolution of corporate governance, right? So you have to connect with the stakeholders, you have to comply with the regulations, you have a lot of other regulatory requirements also. So considering all these in mind, this is how corporate governance has emerged, and it has a lot of benefits which I've already told you, right? So we discussed about. Now we also have something called as the theories of corporate governance through board management. So we have in total 4 theories which may be asked as a objective question as well as a proper subjective question. Maybe write a short note on, or maybe you have been given a particular situation and this theory is, you may be asked an MCQ also. Stewardship, where the directors decide and drive. So they are the stewards of the company. Agency, the directors act as the agent of the company. Stakeholder, we include stakeholders. And trusteeship, they are given authority, and it is all about trust. So they are the relationship of trust established, and they're being handed over a huge amount of money which belongs to the company, right? But there is a relationship of trust which involves over there. With this, we come to the end of our very first unit. We move to the next unit of corporate governance, which is corporate governance practices or codes in India. Okay, so for that we have the very first one, which is Cadbury Committee. Cadbury Committee, or you can say Adrian Cadbury Committee. It was set up by Security and Exchange Commission of USA. So it is not an Indian committee which was set up, right? Any committee which is being set up or which is being formed is for a particular purpose. That okay, fine, you do that feasibility study, you research, and you bring your own recommendations that this should be imbibed in law, right? So they also, every committee comes up with their own set of recommendations. There are many recommendations which have been made mandatory by law as on date, but this is backdated what we're reading. Okay, fine, this particular committee was formed back then. So Cadbury Committee, what were the recommendations? They said that listed companies should have audit committee. We know that it is mandatory now, right? And such disclosures should also be made in the annual report. Whoever is the statutory auditor as well as the finance auditor, they should attend all the meetings of audit committee, right? Other members or other board members may also have the right to attend. And the audit committee is going to discuss with the external auditor about the scope of audit, like which audit firm is engaged and all that part. And the chairman of audit committee will be available at annual general meeting to answer the queries. So these are broadly 4 points which you should keep in mind. Next comes your Rahul Bajaj Committee. Now this is Confederation of Indian Industry constituted this particular committee. So it is an Indian committee. Now it recommended, what were the recommendations? They were very short recommendations that you have to study. The recommendations being that only listed company, okay, with the turnover of either 100 crores and paid up capital of 20 crores have to set up the audit committee, right? Ma'am, both the conditions have to be complied with? No. Lesser, whichever is less, that you have to comply with, and if you comply with that, then you have to set up an audit committee within 2 years when you reach that particular threshold. Now audit committee is undoubtedly there to assist the board. Then comes your KR Chandratre committee, which is again an Indian committee, and it broadly focused on audit committee only. So companies with paid up capital of 5 crores, they should have audit committee. Now audit committee will discuss with the auditors periodically. Audit committee will have the authority to investigate also. So investigation powers will also be given to audit committee. Which matters it can investigate? It can investigate matters on its own or those which are referred by the board of directors, right? And then there will be punishment also for non-compliance, which includes imprisonment. And the chairman again of audit committee will be present at annual general meeting to answer the queries. And lastly, we have Kumar Mangalam Birla committee, which is an Indian committee which was set up by SEBI. So this is actually an important one, and you have a lot of recommendations that you have to read about it. It has certain mandatory recommendations and certain non-mandatory recommendations also, which are just recommendatory. Okay, so it came up that this should be made mandatory and this can be made optional, or this can be made voluntary. Half board to be independent. Half of the board of directors should be independent, but if the chairman is non-executive, then 1/3 may be independent. Okay, fine. Companies with a capital of 10 crores and net worth of 25 crores. You can leave this particular point. In fact, I haven't even incorporated this particular point in my charts. Committee will be there for investor complaints also. That means a committee should be formed which is going to study investor complaints, which we have today, right? We have stakeholders relationship committee, we have nomination and remuneration committee, which is also recommended by this particular committee. Okay, so there will be audit committee which was going to investigate. There will be a committee for investor complaints. There will be a committee for nomination and remuneration, right? And then the chairman of these committees will be present at the AGM to answer whatever shareholder queries they have, right? Then annual report should have a lot of details about the directors which are being appointed. Okay, now the next topic that we have is principles of good governance. So we have a board level and we have below board level. What is board level? Standardized, regulated by Companies Act and loader regulations. As I told you, when we talk about corporate governance, it flows from top to bottom. So at board level, everything has been made mandatory. A lot of things have been made mandatory. Where do we read about corporate governance, which board of directors have to comply with? It is regulated by Companies Act, and also major portion of it is also regulated by loader regulations. SEBI loader regulations is nothing but it is corporate governance only. But obviously it does not apply to all companies, whereas when we talk about Companies Act, mostly provisions apply to all types of companies, right? So if I say that, okay, fine, if you're a listed company, you have to have a woman director. So that is what? That is a step towards corporate governance only. The loader also regulations also have a lot of content to it. Below board level, every company has their own code of conduct, and undoubtedly they have their SOPs, standard operating procedures, they have their department manuals. So that has been designated or designed at the management level, and it flows from top to bottom. That is top down approach that I've already explained you, right? Now we have certain things that we have to read about independent director also in the chapter of corporate governance. Although you know about independent directors, which you have read under Companies Act, but here also we have certain things, and we'll have a broader perspective apart from what is strictly written in law, right? So independent director, there is a code. We all know that Schedule 4 of Companies Act 2013 gives us the code which has to be followed by the independent director. How an independent director will be appointed, we already know that. But here we have something else. We have to ensure, apart from the disqualifications, you also have to ensure that he must possess the appropriate skills. And he will be approved at a general meeting. There will be a letter of appointment which will set out his term, the company's expectation from him, the duties, provision for director and officers insurance, if any, and code of business ethics which he must comply with. Independent director should always have high standards of integrity. He should perform his duties. He should do whatever he is doing for the benefit and interest of the company, and he should not involve his personal benefit. So he should keep his professional obligation different or separately, right? He should not do any type of activity which ultimately loses his independence. So he should assist the company, he should assist all the board of directors in the best possible manner, right? So we have certain things from examination perspective. We have the roles and functions of independent director, which we have to read. We have to read about the duties of independent director and the manner of appointment. Manner of appointment, somehow I've already told you. When we talk about the duties of independent director, so duties, independent director should regularly update his skill, take professional appropriate advice whenever needed, attend all meetings, whether they're general meetings, board meetings, committee meetings. He should keep himself well informed, report concerns about any unethical behavior that he comes across. He should not disclose confidential information or unpublished price sensitive information. Okay. So, of course, there are more points, but these points should be sufficient. Then we have something called as corporate governance ratings. Whenever we rate anything or anyone, it determines his relative standing. See, you cannot say this is A unless you have a D also, right? So when you're rating someone, it determines your relative standing. Okay, fine. This has been rated as B and this has been rated as A. Then on the parameter or on the tenets of corporate governance, this entity is better than this. So this is better. That is the relative standing, right? So it determines the relative standing of an entity with respect to other entities, but we're talking in terms of corporate governance only. We're not talking in terms of any other thing, right? So when I talk about corporate governance, there are certain cases where you have to have these ratings, right? There is also a compliance report which has to be furnished by listed entities. Compliance report on what? Compliance report on corporate governance. So for that also we have different annexures. I think I have, okay, I'll tell you that, right? So we have that also. That is one parameter. There is another parameter that, okay, corporate governance ratings, they help the stakeholders provide a lot of information. They helps to determine which entity is better. That is, it helps to establish the relative standing of an entity, right? It enables the stakeholders to form a better decision, right? And it see, we have three aspects. Although we have a lot of assessment criteria, if we are being asked in examination that there is Mr. Sham, Mr. X, whatever, he is a stakeholder and he wants to know how this particular company is performing on the tenets of corporate governance, right? Or as an employee, if you want to join a particular company, you would be willing to know that, okay, what is the relative standing of this particular company when I talk about governance. So for that, we have three components. When we talk about this corporate governance ratings, we have ESG ratings, which is the similar thing. So we have environment, we have social rating, and we have governance rating, right? So when we talk about environment rating, we check the environmental key metrics, right? And based on that, the rating is given. When we talk about the governance rating, we check about the board governance, who is governing the company. So what is the ideal composition of board of directors? What is the pay that you are giving? Ownership and control, inclusion of stakeholders and all, and accounting about the maintenance, disclosure, transparency, everything. And thereafter, we have social key metrics, which incorporates other things, right? So based on three: social rating, environmental rating, and governance rating. So you may be asked in examination, what are the three types of rating? When you're being asked the types of rating or ESG ratings component structure, this is what you have to write in examination. Now, you may also be asked about the assessment criteria. That means, which points should be kept in mind while you are assessing about the governance of any company. So you should check about the board structure, you should check about accounting, you should check about professionalism, you should check about the disclosure, you should check about the grievances. Whose grievances? Investor, customer, vendor. How these grievances are being dealt with, how much CSR they are doing, right? How much dividends they are being paid, how much compliance they are doing with the law, right? How much disclosure they are doing, how much they're incorporating shareholders in their decision making, right? So all these points should be kept in mind while deciding about the ratings. Then, if I come about to listed entities have to submit quarterly compliance report on corporate governance to recognized stock exchanges, and there is format which is being given in the annexure. So we have annexure 1, 2, 3, 4. So these are the 4 things that you have to keep in mind. Annexure 1 on quarterly basis, annexure 2 at the end of the financial year, annexure 3 at the end of 6 months from the close of financial year, and annexure 4 on half yearly basis. In the regular class, I've even shown you these annexures and explained you what these are all about. We move to the next unit, which is corporate governance in family business. The family business is all about where majority voting power is in the hands of the controlling family, like we call Ambanis, right? Now, what happens over here is that you may call it family business, you may call it a family company, you may call it family owned business, whatever you may call it. Here what happens is that the power is concentrated in the hands of family, the power as in the terms of voting, as in the terms of decision making, right? Now this leads to a lot of advantages and this leads to a lot of disadvantages also. If I prima facie talk about the features of such family owned companies which we have in India, the directors or the senior management are from the family only. The formation of a lot of groups is common, right? Coterie is common. Emotions are attached. There is dilution of shareholding from generation to generation because we have 5 children, then we have to dilute the shareholding amongst 5 people, right? There will be conflict of interest undoubtedly. In a family of 2 there is a conflict. So whenever we are talking about the family owned businesses, there will be undoubtedly conflict of interest. Now the ones who do not belong to the family, that is the non family directors, they're actually defunct in decision making, they're not involved in decision making, so they just have to blindly follow what the family members are saying, even if they're not very much competent or more competent than the non-family directors. Hardcore professionals thus avoid working or joining such companies because they don't feel the worth, right? Even if they have something to contribute, maybe the family is not ready to accept the same. And the death or disability of any senior member leads in management crisis. Why? Because they are the ones who have expert knowledge, they are the ones who are leading a family, and if they die, then ultimately the whole business gets shattered because there is no one who is competent enough. There may be, right? Even some family members may not have these features. These are the general features or the common features that we find in family businesses, right? So they may be present, they may not also be present, right? Now, the emerging issues in such businesses are dealt by separation of ownership and management. So now the ownership is in someone's hand and the management is in others' hands, right? So family members are also growing. They're acquiring professional courses from reputed institutes. Their promoters are encouraging more professionals to join the company. The role is being decided at the board level. That okay, fine, this is the role that you have to do. So that role, the person will be restricted to that role only, right? Owners are accepting the decisions of managers. So whatever managers are contributing, the owners are willingly accepting. And you can also form a trust and thereby make your son or your daughter the beneficiary of that trust so that he gets the benefits, but he's not involved in the direct management, which leads to better managing of the company. The next unit that we have is all about CSR, and we also have some guidelines. What are these guidelines? Earlier, we had NGRBC, earlier we had National Voluntary Guidelines, which is NVGs. Now we have NGRBCs. So here I have written in short 9 points. You don't have to read them in much detail, but of course you should know all these 9 guidelines. Since it is a revision, I'm not taking you to the actual flow of these. But yes, businesses should conduct and govern themselves with integrity. So undoubtedly there has to be honesty and there should be a manner of transparency, ethical and accountability. You should provide only such goods which are sustainable and safe. We will read about the sustainability. That means you're not compromising, you're not compromising on the future needs or the needs of future generations. So, whatever you're using in your business, you have to ensure that the needs of future are not being compromised with. Right. Businesses should respect and promote well-being of all employees. So whoever is employed, if I'm talking about the value chain, it is right from start to the end. So whoever is employed, whoever you're taking help of, whoever is working for you, you should promote the well-being of them. You should respect the interest and be responsive to all of its stakeholders. Supposedly there is a vendor grievance, supposedly there is any shareholder grievance, so you should be responsive towards everyone. You should respect and promote human rights, very important. Make efforts to protect and restore the environment, so emit less industrial waste, try to bring different ways of recycling, try to restore environment in the best possible manner. Then sometimes you may be involved in policy making, you may be a part of it, so you should take that in a responsible manner. You should promote inclusive growth and engage with your consumers in a responsible manner. See, it is very important whether you are in a product sector or you are in a service sector. If you're providing a particular product, you have to ensure that it should not be hazardous. You should have to take that responsibility towards consumers and ultimately thus provide whatever you're providing, right? After that, we also have something called as CSR. Right. CSR is covered under Section 135 of Companies Act 2013. We all know that, right? Now, in CSR, this is the overview what we read in Section 135, read with rules, and then we also have a different perspective. It's actually extracted from the rules only, but still. Steps in the implementation of CSR, that also we will see. So, company which complies with any of the following conditions has to go for CSR. Net worth more than equal to 500 CR, turnover more than equal to 1000 CR, or profit more than equal to 5 CR. So if any of these conditions is complied with, you have to form a CSR committee. And that CSR committee will recommend a CSR policy which board will approve, and thereafter you have to have a minimum expenditure of 2% of average net profits of preceding 3 years as your corporate social responsibility. Okay, what is going to be that expenditure as approved or as covered under Schedule 7 of the Act? However, if your expenditure is not exceeding 50 lakhs, then you don't need to form a CSR committee. What you can do is your board itself can have a CSR policy and they can go for CSR expenditure. You have to have CSR expenditure, but CSR committee is not required. However, if CSR committee is mandatory, then it should be composed of 3 or more directors, out of which at least one shall be independent director. Your CSR policy is going to be placed on the website and also contained in the board's report. How can you implement CSR? That we'll read actually later. If you take any activity outside India, that is not going to be considered as CSR. If you contribute anything to the political party, if you do any activity in the normal course of business that you do, or which benefits only your employees and their families, that is not going to be considered as CSR. Now, you have to do that CSR expenditure. Sometimes what happens is that the CSR expenditure exceeds, or you can say it is invested in such a project which is not completed in 1 year. So directly we cannot apportion the expenditure to that particular year. Maybe you have a requirement of 1 crore in a particular year as CSR expenditure, but you take up a project of maybe developing a school which requires a duration of 2 years. So in the first year, you have spent only 50 lakhs. However, you were required to spend 1 crore, but you could spend only 50 lakhs. Now, what you can do is, for such ongoing project, if the amount is not spent at the end of the financial year, within 30 days, you transfer that 50 lakhs remaining to unspent account in scheduled bank. Okay, it will be considered as CSR compliance. Okay, and it has to be undoubtedly used within 3 years. And if you have spent excess, then it can be set off also. Now we come to the next part, which is CSR implementation. Okay, how do you implement CSR? First is determining the thrust area. See, there are a lot of areas where you may go for your social responsibility. So you have to decide a domain. You have to fix a particular area. Okay, fine. This is the area where we want to contribute. Okay, where we want to spend money. So you have decided the target area. Thereafter, you identify the project. Okay, in this particular area, maybe we want to develop a particular school. So that is your project. Project is we want to build a school. Then you evaluate the CSR project. Before making expenditure, you are doing that evaluation. What evaluation? That what will be the nature of the project, what will be the cost involved, the linking, who will get benefits of the beneficiary, how much feasible it is, feasibility from all perspective, what will be the time involved, how are we going to monitor it, will the impact of this particular effort of ours be measurable or not. So all that you are evaluating, right? After you evaluate, you go for implementation of the same. Now, implementation may be direct or through third party. See, we have certain specialized implementing agencies also. If we go or look at section 135, any CSR activity may be implemented by a company. You can form your own section 8 company. You can use section 8 companies. I am saying the broad term. Okay, we have in-depth things. I'm saying the broad term. You can form your own section 8 company. You can have the company or the registered trust which is formed by the government or act of parliament, and you can have other also. But if you are going for others, then they should have a track record of 3 years in similar activities. Okay, now there are specialized implementing agencies, like if I talk, there may be the panchayats or voluntary agencies, or there are self-help groups, a lot of Mahila mandals and all. So through them also you can go ahead for your CSR expenditure. Now, there are advantages as well as there are disadvantages of direct implementation. So if you go for direct implementation, it will be flexible. You will have a better supervision because it is being directly implemented by you only. So there will be quick decision making, less coordination, less cost. At the same time, you might not have adequate manpower, you might not have that domain knowledge, right? You might be biased towards a certain thing, you might not take corrective action, right? Maybe you have lack of monitoring, or you have lack of local area knowledge, you don't have that language is not known to you, right? So a lot of things may be creating problem also. If we go for third party implementation, again there will be advantages, there will be disadvantages. Advantages, there may be better supervision, there may be expertise, they may be unbiased, they have a single point of coordination, right? You can negotiate a lot of cost and you can cut down cost when you are hiring a third party for that, right? There are disadvantages also. What are the disadvantages? Disadvantages, maybe there is more supervision involved because it is not your direct thing that you are doing, right? Maybe they do not have that domain knowledge which you have. Maybe they are biased because they have a certain beneficiary to cater, they want to cater that only, right? Maybe they're not maintaining proper accounts, maybe they're not telling us the negative points, right? Maybe they're dominating a particular area, right? So there might be different problems also. Now, if I talk about implementation, there are internal and external problems which are being faced in the implementation phase, as in preferences deciding, mismatch financially, lack of seriousness, right people to work, you don't have them, internal references, differences in opinion. And if we go for external things, we have political pressure, we have social pressure, we have inefficient implementing agencies, or maybe they are diverting, siphoning money. This is a huge point which I'm diverting money or siphoning money. Siphoning money is a huge point, so I'm not getting into it right away. fraud. There may be fraud involved. There is an NGO to which you have given 1 crore rupees, but ultimately they're not even working towards it. It is not ultimately going to a beneficiary. So maybe. So these are the issues that we face, right? Now we come back to the evaluation after making the expenditure. So we go back. After making expenditure, how can you evaluate? So you can make a team of 2 3 officers who inspect the document. They make a report, right? And the report is placed before the CSR committee. It is recommended to board for approval, right? Agreement is made by the company and implementing agency for the execution and all that, right? Now, after you have completed this, the next step is monitoring, and monitoring should not be done at the end of the project. It should be done periodically, right? So you can assess the progress, how it is going on, and if there is any wrong thing which is found pre-hand, then you should take immediate corrective action. Thereafter, you have something called as impact assessment. Impact assessment actually helps you to know that whether spending so much of amount was worth it or not, right? So it should preferably be done by an independent third agency, right? Because you might be biased, you might be thinking, no, it was helpful. Or somebody who has taken decision, if they are doing the impact study also, they will definitely say, yes, it was very impactful, it was very helpful, but no, ultimately maybe it was not helpful, right? So, and it should be focused on the impact only. It should be done immediately. If I take a particular session, if I ask you immediately, was it effective, you will say yes. But if I ask you around 15 days later, no ma'am, we hardly found any, because you tend to lose that memory. That memory fades away. You don't remember, okay, ma'am told me this, right? This was effective. So the same thing happens even in case of taking up a project, right? Whether it is effective or not has to be done immediately after the benefit is being given, right? And then we move to the last unit, which is actually a short one, sustainability management. So we have 3 approaches to sustainable development, which is social, environment, economic approach. Social approach is for the people, environment is for the planet, and economic is for the profit, which is also called as triple P, right? Triple P approach or triple bottom line approach, whatever you may call it, right? Now, a manager has a lot of areas or a lot of steps that it has to undertake. The same goes for sustainably managing the company also. You have to identify the problem, you have to set the thrust for solution, you have to set a target, evaluate a project, select that project, plan action, use technology, innovate, schedule your actions, organize staff, directing, monitoring, corrective action, and review. The same thing goes here as well. Now, sustainability management or sustainable management is what? You are not compromising on the needs of future. You are fulfilling the needs of present, but without compromising the needs of future. That is something which is very important. So you have to maintain the quality of life on this planet, right? You should do such businesses, you should undertake such activities which are sustainable. If you wish to stay in the business, you have to ensure sustainability also. Okay, so this is something which is important. Sustainable management maintains the economic viability, it limits the resource depletion, it maintains quality of life on planet, company can generate more savings, and it can lead to better performance also. Thereafter, we also have something called as sustainability reporting, for which we also have read about ESG ratings. So there we have to, the listed entities have to give a compliance report on CG. There that is being incorporated, right?